does worsen. They don't want to be looking back and seeing massive surpluses of oil. They want to react ahead of it. And that's, I think, a bigger part of it. But of course, it helps to preserve their reserves as well and just kind of take it a little bit easy rather than stressing their system. Saudi Arabia is producing at 11 million barrels per day right now. That's not a number they've done sustainably in the past.
Amrita, there's a huge political overtone to this. We were talking earlier about President Biden going to Riyadh and this issue of the U.S. and other Western nations relying on OPEC Plus to produce more. What's the pushback likely, and how potentially damaging is it for the U.S. to reduce exports at a time when Europe is arguably more flat on its back when it comes to energy than the U.S.?
I mean, the irony of calling Europe allies and then banning exports is going to be something I'm sure Tom and you will discuss this at length at some point. But look, I'm in the US. I've been meeting with producers for the last week or so. US production is really underperforming and nobody's talking about that. But that's probably why, even though the White House won't admit it, that's why they're going around the rest of the world asking for more production. I have also heard from producers yesterday that there have been conversations ongoing in the White House for potentially restricting exports. It's going to backfire, but this is a global market. All it's going to do is get WTI prices down, but Brent's going to skyrocket and product prices are linked to Brent. It's not going to do anything to gasoline prices at the pump in the US.
Amrita Sen, thank you for energy aspects on the latest. The domestic politics here not lost on anybody going into the midterms. Hardly original. Of course, it makes sense. They want gas prices down going into the midterms. And gas prices just recently are starting to go the wrong way.
There's this
just
on radio, we're doing that little fancy...
Just a little bounce.
QE up. I agree. And to what she said there, can you imagine October 20th, October 25th, and oil, Brent crude prints 101, as Amrita alluded to there.
And gasoline prices are climbing. There is a belief, among some people at least, in this oil market that by, I wouldn't say exhausting the SPR, but really bringing it down aggressively, you've made the market more fragile. You've made the market more fragile and more prone to the kind of things that we're talking about, squeezes, rallies.
Especially if you do have a lack of spare capacity, because that means you cannot increase production on demand. And what I'm most interested to hear from this particular meeting is how much they emphasize that versus the onset of some sort of recession. Because as Amrita was saying, in the physical market, there still is a significant amount of demand. And we've heard from analyst after analyst, Paul Sankey yesterday saying they expect demand to increase next year. People are still traveling. We still need commerce. And what happens if China comes back online, which you're seeing on the margins with respect to activity? So all of these issues kind of come to this muddle. And when you have a lack of supplies to unleash onto the market like the SPR, that's the point about fragility.
The gasoline prices don't have a 5-handle, Tom. On average, they have a 3-handle still, 380, but pushing 4 again. And that starts to get uncomfortable, I think, for the White House.
I agree. Is it the? I don't know. It's close to the topic. It really resonates.
I would argue it's been one of the issues of the year so far, at the epicenter.
I mean, we used to be in Boulder,
higher costs.
And we'd be at the sink in Boulder.
What would you be paying for the gasoline?
It was 95 cents. A pitcher was, no, the sink is a bar. We'd be paying $2.95, $3.50 for a pitcher. John,
I thought you were bringing up something connected.
John, I'm bringing, this is important. We think
gasoline.
nothing of a road trip to Fort Collins. You just get out west, you just get in the car and go.
Sure.
You just go.
That's been the story of the year.
Yeah, well, that's America.
Welcome to 22.
Yeah, but you go back about $4 a gallon, you get up to $5 a gallon. I'm sorry it matters across a huge part. So, look at all of us. I mean, I've been below 59th Street in 4 months.
Don't drag me down with you. Your elite group over there.
Yeah,
I'm not a part of that.
I know.
At all. Tony Crescenzi of PIMCO is going to join us shortly. Looking forward to that. Futures right now negative on the S&P 500, on the Nasdaq too. Negative after a big day of gains yesterday and the day before. From New York City, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Elon Musk's decision to revive his $44 billion takeover of Twitter is great news for a number of investors. They include billionaire Carl Icahn and arbitrage traders who continued to bet on the outcome of the deal through months of uncertainty. Now, after Musk said he would move forward with the agreement at the original offer price, Twitter stock rallied as much as 23%. The Biden administration is trying to keep OPEC and its allies from making the biggest cut in oil output since 2020. OPEC Plus is meeting today in Vienna, where energy ministers will consider cutting production by as much as 2 million barrels a day. Bloomberg's learned that U.S. officials are making calls to counterparts in the Gulf, trying to push back against the move. President Biden had a muted response to North Korea's missile launch this week. He pledged to work closely with Japan and South Korea, but in a sign of permission about a bigger breakthrough, he held off, promising much more. The North Korean missile was the first to fly over Japan in 5 years. United Airlines will become one of a handful of major carriers to resume passenger flights to Hong Kong. Bloomberg's learned United will start flying there as soon as January. Hong Kong has been largely cut off to the outside world since the start of the pandemic. And in baseball, Aaron Judge of the New York Yankees is now in the record books. He hit his 62nd home run on the season Tuesday night, and that breaks a record set by Roger Maris of the Yankees in 1961. Judge has set himself up for a lucrative offseason. He'll be a free agent, and before the season, reportedly turned down a 7-year, $213 million offer from the Yankees. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition, and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
CFOs are reshaping the C-suite, breaking out of traditional roles to become Chief Future Officer. Global logistics is complex. It takes plenty of capital and plenty of focus. Deutsche Post DHL Group CFO Melanie Kreis makes sure her company has both.
My role is essentially saying what is working well in this company, where do we have challenges, and what should we do going forward.
Chief Future Officer, today on Bloomberg. Brought to you by Workday.
Strong enough to stay, we will never.
Material samples brought back from objects in space can shed light on billions of years of our solar system's history, including details about the origin of life here on Earth.
A piece of an asteroid is a piece of the earliest beginnings of a solar system.
But picking up rocks from the surface of an asteroid or planetary satellite isn't as easy as it sounds. It requires voyages of millions of miles to bodies that have never been seen up close. Probes need to land on surfaces with weak gravitational pulls, where the surface terrain is completely unknown. gather samples, and then make the long trip back. And while behemoths like NASA and SpaceX grab headlines, it's a relatively young space agency. The Japan Aerospace Exploration Agency, better known as JAXA, that is taking the giant leap necessary to bring the mysteries of space back down to Earth.
Markets in general are looking for this sign that maybe central banks are, reaching the highest level of rates that they can get. Maybe we're at peak pricing. But for the Fed, at least, I would really caution that, we've been here before. We've been looking for this peak before, and it really hasn't happened.
Fantastic to catch up with Veronica Clark there, Citigroup Global Markets Economist. On a team with Andrew Hollenhorst looking for another big move from this Federal Reserve next month. Live from New York City this morning. Good morning. Here's the price action for you. After 2 days of big gains on the S&P 500, we're lower by 0.8%. We're down 28 points on the S&P 500. Yields go the other way. You guessed that, didn't you? Up 5 or 6 basis points on a 10-year to 369, and a dollar is stronger. Euro dollar 99.18 with negative 0.7% on that. And as we anticipate potentially a big output cut at OPEC Plus, crude Tom 87.17, positive 0.75%.
John, what matters from the WTO gas, and this goes right into the fixed income market, is it adapts and adjusts and tries to gauge, is merchandise trade. The animal spirit of trade out there next year goes from 3.4% to a stunning 1%. That is a global trade recession.
They've been very bearish before most.
They've been leading
I have to say
bearish.
that. Typically, we joke about the IMF, the OECD coming out in forecasts and confirming what we already knew. I have to say the WTO came out pretty much in front of most of those organizations.
No, there it is, and it's a backdrop there, 1% again for 2023 in merchandise trade. Tony Crescenzi has these numbers tattooed to his brain. He's with PIMCO and is truly expert in the short-term space in the bond market. What does fixed income do, Tony, given a global recession and certainly from WTO, a trade recession?
Well, the bond market is starting to think about that possibility, and these yields, therefore, make it a propitious time for investors, an attractive period. The bond market's thinking the economies will weaken. They're not sure, so there's some risk premium, you could say, in prices of various assets, equities in particular. So I think it's just the uncertainty factor that's keeping markets on edge because we're not sure about how inflation will evolve in particular. But as long as there's vigilance by central banks, and there will be, it seems, Volcker-esque style in the United States, for example, it's highly likely that the inflation rate will decline. There will be disinflation. The bond market will look increasingly attractive to investors, especially if the WTO type scenario where global trade volumes shrink as much as they expect. I mean, it's shrink relative to...
Well, let's cut to the chase. Is PIMCO extending duration? Are you loading the boat on high yield this morning, Tony?
PIMCO's been underweight duration for some time. We've been reducing.
Yes, you've been leading on that.
We'd rather keep it close to neutral. Remember, when you're thinking about duration, interest rate sensitivity, you're talking about a directional strategy. If you open up the Frank Fabozzi 1,500-page book on bond investing, you see there's a lot more to do than simply bet on the direction of interest rates. And that's what PIMCO is trying to do right now, just try to stay up in quality and try to not make directional bets, to look for assets that we think would bend but not break in a time of recession and would withstand lots of different types of economic outcomes. But all that said, duration underweight, slight underweight, given the recent drop in yield, slight underweight might make sense. But remember, Tom, the Bloomberg aggregate has a duration of 6.6 years, meaning if yields move a percentage point, the investor would lose 6.5 points.
Tony,
so a slight underweight wouldn't be much.
You said something interesting, a slight underweight. Does that imply, hi Tony, does that imply from your perspective that we have not yet seen peak yields?
It's difficult to say. There's a wide range of scenarios, but yields today are closer to their long-term averages, and that makes it a very attractive time to be investing, for one. Secondly, the yields in the Bloomberg aggregate today, which is a compilation, by the way, for those who don't know, of treasuries, mortgages, corporates, and a bunch of other securities. It yields today, the yield is 4.6%. Now, how does that compare historically? Very good. It's closer to the long-term averages. That's one reason why bonds look quite attractive today. Secondly, where do you think the inflation rate's headed? The bond market seems to think into the low twos eventually, so that yield, high fours, looks attractive on that basis. And finally, as Tom alluded, if economies weaken, there's a chance for capital gains in fixed income now. And so one doesn't want to miss out on that. And so you have to question, are you really interested in timing the diversification benefits of bonds, which, of course, this year haven't been quite apparent, but we think will assert themselves over time?
How much are you seeing, Tony, a lot of just mom and pop investors pile into short-term treasuries for the first time in a long time? How much are you seeing those cash investments really balloon in a way that feels sticky to you, that will transform the rest of the markets, because that is money not going to equities, not going to high-yield bonds?
I recently took a trip to Asia, Korea, Singapore, and Thailand. So lots of investors there. Today I'll travel to San Francisco from New York. Been traveling a lot, seeing lots of clients, talking to them on Zoom, etc. It seems like the wagons are circling, but of course, as you can see by the global fund flows, investors are still leery. All that said, investors seem to be willing to move into the center of what we would call the concentric circle for investing. The concentric circle would have the riskless securities, treasuries, at the center, and the most risky securities at the perimeter. So investors are seeming to want to move toward the center of that concentric circle, and will slowly work their way out when they gain confidence. It'll take lots of things, lots of scenarios, of course, you can envision that that cause that to occur, but they're not in place yet.
Tony, I've got some CCC unsecured debt for sale. What kind of interest would you offer on a CCC social media company?
Yes. Send it on Twitter.
As you know,
struggling for direction.
50%.
What do you reckon
it's
the
not
coupon?
in areas.
What would that be,
So
Tony?
on the concentric circle, think of a solar system, and the concentric circle looks like that. That's like going way out to the outer perimeter of the system. So, and that's a risky gambit right now, given the uncertainties about economic growth and cash flows. Because at the end of the day, what a bond investor cares about is cash flow, getting his or her its money back. And of course, in a dour economic scenario, it becomes uncertain.
Very diplomatic, Tony. Thank you, sir.
He was very diplomatic.
Tony Crescenti there at PIMCO. Do you think that the team at Morgan Stanley and Co. will be down in 1-800-PIMCO to see if Tony wants some of that stuff?
They're going to dial 1-800-TWTR Equity FA, which is the financial analysis John cash flow. 700 million plus, 120 million plus, negative 380 plus, negative 850 plus. I believe that's a trend.
It would have been a tough sell back in April. It's a much, much harder sell now, that's for sure, Lisa.
In April, it was considered overpriced. Now it's considered ridiculous, at least by market pricing. If you talk about where valuations are when it looks at the debt financing, again, how much pushback is there going to be from the banks? Basically saying, really, Elon, now you're doing this to us, heading into the year end?
I'm looking forward to reporting on this. And for that matter, I'm looking forward to the bank earnings, because some of them might actually reference this without actually naming the company, but I'm looking forward to seeing what they actually have to say.
It's going to be the fall of hung bridge loans, and that's jargon for basically debt that they have already committed to a number of different financings, usually leveraged, that they have to sell, and they have to sell probably at prices that are lower than what they would have sold earlier this year.
Pros at this. Let me ask the grizzled pros. What is secured with Twitter? What do you, if you have secured debt, what do you secured against? You get a factory?
You get the offices.
you
get the offices.
I don't know, I'm asking.
You get verification status.
Get verified.
Coffee mugs.
Exactly. Full verification.
Coming up, John Stolfers, Chief Investment Strategist at Oppenheimer Asset Management, live from New York with Futures Negative. This is Bloomberg.
What are the moonshots at Amazon that are capturing most of your time and attention?
Well, we have a unique way that we look at big new investments, and I'm not sure it's right or wrong. It just happens to be our way. And we ask ourselves when we're considering something 4 questions. We ask, if it's successful, can it be big and move the needle at Amazon? Is it being well served today? Do we have a differentiated approach? And do we have competence there? And if not, can we acquire quickly? If we like the answer to those questions, we'll go pursue it with a single-threaded team that isn't distracted by the rest of the business.
When it comes to the stock, it has fallen significantly. Do you think investors are missing something, or has tech just been overvalued?
I have never tried to predict what the stock's going to do, and any time I've tried to a little bit, I've been wrong. I do really believe that in the short term, the stock market tends to be a voting machine, and in the long term, it tends to be a weighing machine. We have a concept we talk about a lot at Amazon, inputs and outputs, and the ultimate output for a company is share price, and then other big outputs are free cash flow or profit or revenue. You can't really manage the outputs. You have to manage at the input level, and that's where we spend all our time. And so if you do the right things for the business long term, things tend to work out. I think we've had very good returns for investors, and I expect that to be true again.
When you've had your fill of IPOs, ETFs, and CPI,
tune into the lineup for some NFL, NBA, and MLB. Did you retire too early? I mean, look at some of these payouts.
I absolutely retired too early.
For the inside scoop on sports betting, catch the lineup right here on Bloomberg.
A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
From New York City.
We're in London, in Sydney,
in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this
How
story.
are you thinking about those dynamics?
Inflation's the number one priority. Until inflation is under control, monetary policy will still have to chase inflation, trying to cap it.
I think central banks will still be hawkish. Inflation will still be stronger than they want.
Markets in general are looking for a sign that maybe central banks are, reaching the highest level of rates that they can get.
Don't count volatility out now, even though we're kind of dropping back to 20 handle levels.
There's a global shift towards a higher returns environment, but you can't get there all in one go.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Futures negative TK down 0.7% following 2 big days of gains on the S&P.
Yeah, news flow today is interesting, but John, I'm going to go out an hour and 14 minutes from now to the ADP report. If ADP jolts you like jolts yesterday, what do these markets do?
ADP out a little bit later this morning, then Lisa on to payrolls on Friday.
And so how much does the market, to Tom's point, respond with a rally? Because that's what we saw yesterday with the JOLTS data coming out weaker than expected, or at least coming in with a bigger drop than expected in the job openings in the United States. Is this viewed as reason to fuel this belief that the Fed cannot go as high as they basically say they're going to go?
It's like a sports game, isn't it? A football match where you'd have these little periods where team soft landing starts to do better. The ISM, you have contractions in new orders for the 3rd time in 4 months. Then you have job openings drop by more than 1 million. Soft landing, you dare to dream. And then you get CPI
John,
next week and change the story
You're just
again.
bugging me here. You know this is a third rail for me. It's the gamification of what we're doing here. And what matters is the data, as we've seen the last 2 days, and looking forward to October 14th.
I personally go back to what Mohamed El-Arian said, what Mike Wilson said, which is the playbook that used to work doesn't work. And that is what perhaps we should be looking at. If this is the gamification, the game has different rules in an inflationary environment where that is the most pressing concern for policymakers and arguably for the economy itself.
Do you know what I'd like? Mike Wilson's crystal ball just on the desk in front of us. I went through the transcript. I went through the transcript of what he told me last week in an interview last night, just reading through the thing. And he basically said, so from here, John, what might happen is yields may well come in, and then equity markets will rally, going into earnings season, kind of like the reverse of what happened in the last quarter, and then you're going to get smacked around the head with what happens with earnings. And here we are, yields came in, equity markets rallied, and we're going into earnings season. I've, again, talked about a short-term rally and then maybe going back down towards 3,400.
He's got an 8-ball on his desk, turns it upside down, it spins around, and one of them says, don't talk to Ellen Zentner, and he puts it back down.
Is that what he does? I'm not sure that's how it works out.
That's one of the choices that he's got in the 8-ball. The Morgan
I'm much more interested in the inner workings of the investment bank at JP Morgan with Bruce Kasman and Marko Kolanovic, because Bruce has a very different view on the world compared to the equity strategists over there.
Well, let's just put this into perspective. Marko Kolanovic, I mean, there's very difficult, you're not leaving me with a lot of room here. So, you know, okay, look, Marko Kolanovic is saying, okay, well, perhaps not this year, our target is good, but next year it will be good. It will be effective next year because it doesn't look likely this year because, gosh darn the Fed, why are you doing this to us?
You mean moving out their target? That would never happen at OPCO.
But this goes to this question of the pivot discussion. Why are people buying into this belief that this is going to save the market when the Fed is saying we need inflation to come down? The inflation isn't coming down. We're going to keep going, and people keep fighting them rather than say, okay, this is what they're doing.
And that's Mohammed's view of the world. Careful what you wish for. If you get the pivot, is it for all the wrong reasons? Futures right now down 0.7%. I'll whip through the price action for you on the S&P, on the Nasdaq. We are negative after 2 big days of gains. Negative on equities. Yields are a little bit higher, up 5 or 6 basis points. 368.88 on a US 10-year. In the FX market, kind of the reverse of what you saw yesterday. So yields up, dollar stronger, euro dollar negative to 99.23, down 0.6%.
Did sterling move on the trust speech? I think it did, a little weaker.
Did it? I didn't see that, Tom. What do you reckon that was on?
I don't know. Trust talked and they didn't like it.
Things move. Crude, positive 0.5%, 86.95. Lisa, going into OPEC Plus a little bit later this morning.
I am so interested to see what happens with OPEC Plus. They are meeting in Vienna. The meeting is supposed to be starting around now. How much they really go into this 2 million barrel cut in production at a time when this is highly political. You have seen Brent crude come down dramatically. Does it pop back up? What does that do heading into a winter? Not only for Europe, but also the United States. You have heard some pushback from the Biden administration on this point. Today we get a host of central bank speak because it is a Wednesday, and why not get lots of central bank speak? Fed speakers include San Francisco Fed President Mary Daly and Atlanta Fed President Raphael Bostic. Very curious about Mary Daly's point that she made yesterday in another speech that she made, where she was talking about the punitive effect of inflation, and particularly on lower income individuals. So as we watch yields around the world surge to the highest levels in more than a decade, how much is this the necessary pain that they need to see to avoid the pain that they're feeling and that they're seeing in some of the lower income brackets, with people really seeing huge negative real wages? And at 10 a.m. we get U.S. ISM September Services Index data. And this comes as we get a series of negative economic surprises. John, this is viewed as good news for the market because people are saying, okay, then the central bank doesn't have to go as fast and as hard as they have been saying that they will. But to the point that we were just talking about, what does that mean about how quickly this economy is moving away from companies and their earnings, from consumers and their ability to spend, not just policymakers, and how much they are committed to bringing down inflation?
Elisa, thank you. Looking forward to the data later. 8:15 for the ADP report a little bit later this morning. Joining us now is John Stolfus, Chief Investment Strategist at Oppenheimer Asset Management. John, wonderful to catch up with you, sir. Let's talk about the price target. 4,800 on the S&P 500 year end. It's clearly been a difficult year for you. You can't get every single year right. I don't know if we get this massive rally in the next 3 months. You can tell me. Tell me how you and the team regroup, go back through the process, look at the framework, and have a little think about where this equity market's going.
Yeah, well, thanks for having me on the show, all. It's great to be with you today. I've got to say, you know, this has been an incredibly tough year for the bulls. It's been a great year for the bears, although both groups have been mauled at different points. You consider what's happened to the shorts at within different rallies. We've had interim rallies, we had a summer rally, we've had this recent patch of rallies that we've just gone through. But when we look at it, what we'll consider is 4,800 is a little bit optimistic here, with about 26% upside from there to a 4,800 target. the problem is that right now the market really has been held hostage by technicals, by sentiment, by politics, by geopolitics, all of which factor into things. But we've got to wait to see what the earnings look like. And most importantly, what happens tomorrow in the jobs number, I think.
Yeah. John, I'm going to cut you some slack on the amount and the timeline of your strategy. Let's say you do go up 26%. Let's say it's to year end or somewhere out there in 2023 as well. Do you need catharsis in the market to get there? Do you need a VIX of 40 to go up 26% somewhere?
You know, and I think we need some support from the VIX in a more traditional sense, the way we've seen, with a really forceful spike to come down. And that perhaps, I think the most important thing to remember is that we're in this situation because of overstimulation of the economy by politicians in particular, in addition to emergency funding essentially by the Federal Reserve in a situation that was really unprecedented in the 21st century, and we'd only had one global pandemic in the 20th century that I can recall. So, not that I was around for the 1918 pandemic, but so when we look at it, Tom, we've got to say there's a lot of uncertainty here, but the market is telling us where it wants to go when it goes through these rally periods. And what it shows, curiously enough, is a pretty responsible barbell. Growthier value, garpier growth. The rallies are a combination of both cyclicals and defensives, with cyclicals in the lead yesterday, clearly. But it shows the battle is between the short-term investors, the intermediate to long-term investors whose goal is beyond where we are today, riding on what they see as secular opportunities, which we certainly see.
John, you said held hostage by sentiment. So the implication here is that the sentiment is wrong, that there is much more optimism right now in the economy, which gets you to that 4,800. So what are you looking for? What do you have to see to change that, to agree with the sentiment that we're headed toward recession, we haven't priced it in?
Well, I think we saw some of that yesterday. Last week, I attended the conference where you had a mix of bulls and bears speaking, and it was I was surprised to hear quite a bit of early bullishness from people who had been pretty negative on the market going into this year and throughout most of the year. What it would appear to be is, the numbers will show, and there has to be a sense of exhaustion from this selling. The question is, when you look at really good companies that are not aggressive growth companies that have dividends, and you look at them, you see they're off 30% year to date, and yet you go into the stores and you still see them being busy. Let's say companies that have all kinds of stuff for household renovation and repairs and things like that, for example, or some of the big banks that are doing business and are still not paying their depositors a heck of a lot on the money, even with rates up. You've got to figure that something's kind of out of whack, and it may very well be that the leverage crowd is in a state of shock because we are leaving a state of free money, going to a place where bond issuers have to pay for the privilege of borrowing money, and bond buyers are actually beginning to get paid for the risk they take when they lend money as a result of buying a bond related to inflation,
connection lost,
credit risk, as well as even callability risk.
When was the last time we could say that? John, thank you. You're a good sport, sir. Can't be right all the time. It's great to catch up with you. John Stolfus there of Oppenheimer Asset Management. Forecasting is really, really difficult. Yeah. It's tough, and sometimes you don't get it right, and the big bulls this year have had a tough time.
I can't say enough about it's like baseball, which I believe in hitting, as you go back to the dugout 60%, 70% of the time. That's what strategy is like. You rarely nail it like Mike Wilson.
Hey,
going in here,
years.
That you take that gift when you get it.
Lisa is our gift, who just nailed it this year.
Yeah, I just nailed it. He lent me his 8-ball. Don't talk to
Zentner.
Yeah.
Bearish.
Yeah, be bearish today.
Futures down 0.8% on the S&P from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. OPEC and its allies may make their biggest cut in oil output since 2020. The move to stabilize prices risks cranking up tensions with the U.S. At their meeting in Vienna today, OPEC Plus energy ministers will discuss cutting production by as much as 2 million barrels a day. Now, that could lead to higher gasoline prices for U.S. drivers. Prime Minister Liz Truss warns that the UK faces what she calls stormy days. Truss spoke to the Conservative Party conference in an attempt to get her beleaguered government back on track. Now, she says she's determined to break out the high-tax, low-growth cycle and that tax cuts show that Britain is open for business. Protesters said to be from the environmental group Greenpeace briefly disrupted Truss's speech, and before they were escorted out. The world's richest person has found a way to potentially avoid a bruising courtroom battle. Elon Musk has revived his $44 billion offer to take over Twitter. Now, that proposal likely eliminates the need for a trial over whether Musk should be forced to go forward with the purchase. Bloomberg's learned that Musk's legal team sensed that the case was not going well. The European Union has backed a new set of sanctions on Russia. Bloomberg's learned that it includes support for a price cap on oil sales to third countries. The sanctions also target a range of individuals and entities, including senior Russian officials and those involved in staging the recently widely condemned referendums. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Nurturing also can come from men, and it's one of the qualities, I guess, that you found in your mentors that also pushed you up. Do we need even more nurturing post-pandemic? Is the way that we talk with employees going to change?
I think talent becomes the single biggest differentiator of a successful entity versus an unsuccessful entity. So you've got to do everything possible to hire, train, retain, put your arms around talent. I mean, you've really got to focus on your talent. In the past, it's always been give them money, show them that they have an upward mobility and can make even more money, and that's the only reason people come to work. I think post-pandemic, we're seeing more and more people say, I have to worry about me as a person, I have to worry about my family, I want to worry about my well-being, my mental health. So we've got to start encompassing people as holistic humans as opposed to a tool of the trade, which means that we have to engage with them head, heart, and hands, not just head and hands. The heart has to be engaged. So we have to show more empathy, show that we care, that they're citizens of the community, they're members of a family, and all of those have to come into consideration as we help an executive or an employee be an employee and be a person of the community and the family. The stakes are higher.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close. Weekdays on Bloomberg. Politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding, and the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
We will never break. We will never break. Build on a foundation strong enough to stay. We will never.
August jobs were right on target.
Pretty much in line with what Wall Street expected.
A Goldilocks jobs report.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
Does this imply that central banks will blink?
They want to see a little bit more slack in this labor market.
I don't think the Fed wants to see unhappy people.
There is a lot of monetary contraction and austerity coming down the pipe.
The September jobs report, Friday on Bloomberg Television and Radio.
Every finance minister, and I add my voice to this as well, is saying whatever we do, we want to make sure that nothing will allow the energy difficulties to flow into financial instability issues. So whatever measures we take will be cognizant of the importance of financial stability here in the European Union.
That has been a dominant story over the last couple of weeks. That was the European Commissioner for Financial Stability, live from New York City this morning. Good morning. Your price action shaping up as follows on the S&P 500. Negative after some big gains over the last couple of days on the S&P. We're negative 30 points. We're down 0.8%. Yields higher, equities lower. We can't break this correlation, can we? Yields up by 5 basis points on a 10-year, 368. Futures down 0.8%. Dollar stronger, euro dollar 99.24, and crude down now by 0.6%, going into this OPEC decision at 85.95. And going into payrolls Friday, I'll give you the update on the survey at the moment. The high right now is 389, the low is 199, and the median is 263. I'll keep you up to speed on the survey as it progresses into Friday.
Than the last couple of days, I think.
I think a little bit of a drift. I wouldn't say big moves here, Tom.
Okay.
263.
Futures negative 32 this morning. Our conversation of the day on the international economy and what it means for America and, for that matter, Britain as well. Ngozi Okonjo-Iweala is Director General of the World Trade Organization. She brings absolutely bulletproof Harvard and MIT economics to the massive task of a WTO finding a place within international institutions. They found it about 6 months ago with the single best call on global slowdown of any of the institutions. All you need to know is Dr. Okonjo-Iweala and WTO was way out front. Director General, thank you for joining Bloomberg this morning. I'll get to the headline. You say merchandise trade is going to slow down off the proverbial cliff to 1% in 2023. What does that mean for the developed world? What does it mean for your Nigeria and emerging markets?
Well, thank you very much for having us. Yes, we've just released our forecast, and it's looking quite grim, a little more grim than we had thought. A real slowdown, and it's happening for several reasons. Of course, the high energy prices in Europe arising from the war in Ukraine are a big factor in this, and the squeeze on household spending, the monetary policy tightening in various developed countries that are happening, and emerging markets also is playing into this. So a whole variety of factors. What does this mean? It means that we're looking at a situation in which a global slowdown is going to squeeze households even more, squeeze businesses, and we may be edging into a recession, if not globally, at least in some.
Director General, because of time, I must interrupt and be rude, but I'm going to do it because this question is so important. Is Jay Powell, is central banker to the world, impinging on global slowdown? Are the central banks moving in the wrong direction? What is your advice off the chalkboards at the Massachusetts Institute of Technology?
It's very difficult. Jay Powell is in a tough position, whether to continue tightening, whether you'll overshoot if you do that because of looking at lagging indicators. It's very difficult to give advice to central bankers now. But there's no doubt that something has to be done about inflation. We just have to watch and see so as not to edge into an overshoot. But far be it from me to give Jay Powell advice on how to run monetary policy.
Ngozi, how much does China factor into your outlooks? How much does the potential for them to open up from a zero COVID policy or emerge from some of the downturn that they've experienced factor in or not to this forecast?
It factors in considerably into the forecast. I'd mentioned the war in Ukraine, I'd mentioned the monetary tightening, but China is another big factor. Of course, the COVID slowdown and what it means, whether it's going to continue and we're going to have other lockdowns, it's a big factor. If China's economy continues to slow the way we are seeing, that will have a big impact on what happens to the world economy, as you know, and I really fear for developing countries and emerging markets.
Ngozi, just to sort of broaden out, we've been talking about how we're witnessing a sea change, where suddenly governments cannot finance themselves with deficits the way that they have before, particularly in developed markets, and central bankers cannot fuel growth by just lowering rates. How do you take that into consideration for not only this year's projection, but projection for growth over the next decade?
Well, it obviously is very, very difficult. What we're seeing in our projections is tremendous uncertainty. That I can tell you is what is really making it difficult to predict. We've never seen this amount of certainty when we do our forecasts before. But what we do see is that this uncertainty is tending to risks on the downside. So that is really impacting. And we need to look at what can we do to turn things around. How can we slow down inflationary pressures whilst looking for tools that can help us restore growth? So it's very difficult to predict. There's too much uncertainty in the air.
Director General, thank you for being with us today. And Ngozi Okonjo-Iweala there of the WTO. Lisa, I think she summed it up pretty much perfectly when Ngozi talked about how difficult it was to forecast next year. How do you forecast next month? Never mind, 2023.
Right, and that the uncertainty itself is now leading to downside risk. And you wonder, especially if you're in a corporate executive seat, how do you come up with plans for investment if you're facing the uncertainty that she's talking about with the bird's eye view of the global economy?
Or for that matter, provide guidance, Tom, next earnings season, the one we're about to go into.
Precisely. I don't think you can do guidance. It's going to be interesting to see what those conference calls are like. What I would say is the equation is Y equals C plus I plus G plus trade. And what we're hearing from the Director General is that's a complete mystery for the U.S. Does that keep us back towards recession? Tilting that.
Two-handle on GDP, potentially. Just getting some news out of Sky News. The Chancellor in the UK is to meet with High Street bank chiefs.
Okay, can we stop?
Home loans, mortgages,
Have I ever
above.
been to High Street in London? What does High Street mean?
Main Street. You go to a bank on the High Street.
So, like, does Jamie Dimon in London have
Barclays.
But it's not like a street, it's a concept.
It's a concept.
No, I'm serious.
You're serious? You're not aware of that? The High Street.
No, I'm not aware of that. I'm an ugly American.
Okay, all right. I'm going to let that go.
Could I just point something
I'm
out?
hoping that you knew that High Street wasn't like Wall Street.
It's Wall Street. It's the same kind of concept, right? It's basically big. But
it
either
like
way,
Wall Street?
they're going to go talk to finance, like, you know.
Two ugly Americans.
You guys are kidding me.
No, but it's the concept. Wall Street's become a concept.
Sure, no, but the High Street is like Main Street, conceptually. Wall Street's actually.
So when the car drops you, north, and you walk north on that street,
so John's not going to be here after
Stadium,
this.
I'm taking a break. Live from New York. This was Bloomberg Surveillance.
What's it going to be?
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
When you've had your fill of IPOs, ETFs, and CPI,
tune into the lineup for some NFL, NBA, and MLB. Did you retire too early? I mean, look at some of these payouts.
I absolutely retired too early.
For the inside scoop on sports betting, catch the lineup right here on Bloomberg.
Coming off the back of the biggest two-day pop on the S&P 500 going back to April 2020. It's been a while. But yesterday, equities were up and yields were doing not much, and this morning it's the other way around. Equities are down and yields are a little bit higher. Futures are down by about 0.8% on the S&P. On the Nasdaq, we're down by 0.75%. Over the previous 2 days, the Nasdaq up more than 5 full percentage points. Quite a run. In the bond market, 2s, 10s and 30s. Compare it to last week, big moves lower. From 435 at the front end down to about 4.1%. On a 10-year, we've gone from north of 4% down to about 360-ish. Sub 370 right now, 367, yields higher by 4 basis points. Same story in the FX market. Yesterday, the last couple of days, it was about equities up and yields down and the dollar weaker. Dollar a little bit stronger. The one thing I want to focus on this morning, though, is what is happening with crude. Crude is still about 30% off the highs of the year if you're looking at WTI, but this one gets a little bit more interesting going into OPEC Plus, Tom. A real conversation about a 2 million barrel a day output cut at a time when I think this White House wants OPEC Plus to be doing something else.
Yeah, I think you're onto something here, John, in that the zeitgeist clearly is looking at this much more than global Wall Street and a 90 handle on Brent. What does that do at 96? I think the mood changes.
I'll tell you who's focused on this, Tom. Main Street in a major way. This White House, politically speaking, going into the midterms, wants gasoline prices lower. Over the last week or so, gasoline prices have started to tick just a little bit higher. Are they going to push on the SPR? Can they do something about restrictions around crude product exports? Or can they lean on OPEC Plus not to make this cut a little bit later? Some of the talk about crude right now, negative just a little bit. That's the cross-asset price action. Let's get you some single names this morning.
Twitter.
We can do that with Lisa. Morning, Lisa.
Good morning. And you know what? Tom's onto something there as well, because there is one name, and it is one name only, that is in markets today, and that is Twitter. Just to give you some sense, yesterday those shares popped 20% as Elon Musk came out and said, all right, you know how I was fighting this 54.20 valuation, this $44 billion buyout of Twitter? I'm still in. Let's go. And that left the banks scratching their heads and saying, what does that mean for us? Right now, you're seeing those shares dip just a little bit in pre-market trading, but still around $52 a share. So still a discount to what it would be if he does complete the sale because of the uncertainty. Let's talk about why there could be uncertainty. It has to do with the debt markets. Right now, banks are holding on to about $12.5 billion of financing commitments for this deal that were made in April. Let's take a look at yields on high-yield bonds from April to now. In April, they were about 6%. Now they are close to 10%, plus or minus, and they are gyrating pretty violently. But this is on average. For lower-rated credit, it's even more dramatic. How much can the banks really sell this, and how much is that going to be the circuit breaker? I mean, Tom, you can go into different gamesmanship and whether perhaps Elon Musk is looking for banks to say no, and then to go back to the court system with a better excuse. You can say whatever you want, but right now this is threatening to cause a real disruption in markets that are somewhat fragile, according to a lot of accounts, and have seen a dramatic repricing in the past 5 months.
Lisa, thank you so much. Greatly appreciated. An important conversation now with someone very informed through this tumultuous 2022. Greg Staples, with decades of experience, head of North American Fixed Income at DWS Group, joins us today in studio as well. ADP in 45 minutes, then claims, then jobs, and the known world is focused on some form of pivot. Your language is soft pivot. What's a soft pivot?
You know, Tom, I'd almost even call it a rotation, a slow rotation. I think that Chairman Powell probably felt he got burned a little bit in June, July, when the market rightly or wrongly interpreted some language as saying that he was ready to pivot, and the market rallied for 8 weeks. And I think that got in the way of the tighter financial conditions that he was looking for. And he's not there yet. He wants to be very careful that he doesn't do that again this time. I think he was probably disappointed a little bit with the rally over the last 2 days. He wants to see tighter financial conditions. You're going to have to get that to slow inflation down.
Okay, it's math-free Wednesday. The fact is the fancy mathy Bloomberg Financial Conditions Index has accommodated over the last 72 hours. To be clear, he wants to push that index to a restrictive stance?
I think he wants to see that.
How far away is he?
I think he's fairly close to it. I think he needs to do one more 75 basis point tightening, but he needs the markets to follow through. If he tightens and raises the policy rate, and you see equities go off to the races like you have for the last 2 days, I think that's going to be counterproductive to what he's trying to accomplish.
Greg, how much confidence do you have that there is some stability to the rally that we've seen in longer-term bonds, as people say that they stand to benefit regardless of what happens?
I have actually very little confidence in what we've seen over the past 2 days. I think the general trend is still higher, but not with the kind of velocity that we've seen, say, through the month of September. 4% might be a ceiling for a while. I'm not sure we're actually going to see that again in 2022. It depends, obviously, on the data that we see over the next couple of days. It's really, of course, as we've all talked about wages as the driver for inflation going forward. We've got a really data-rich week. We saw JOLTS yesterday. We're going to see ADP today. We're going to see initial and continuing claims tomorrow, and, of course, big non-farm payrolls on Friday. So many market participants, even algorithms, are primed to trade on those numbers. You're going to see knee-jerk reactions that you might regret if you trade on it immediately after a week or two.
So this is what a lot of people are saying. Don't trade these immediate knee-jerk movements. Greg, at a time when there is such potential fragility, this is what people were talking about a couple of weeks ago, how concerned are you about one event that doesn't seem that significant, say, the owner of a car company going and buying a company that is social media and then having debt sold that was priced back in April, theoretically, potentially disrupting a market that it wouldn't seem like it would do that otherwise, but because of the fragility, because of the lack of liquidity, this time could be different.
Yeah, it's clearly a question that oftentimes happens in situations like this. I think we take a little bit of comfort of the fact that so many more financial institutions are far well capitalized. There's obviously been a lot of noise about Credit Suisse this week, and we think they're actually very well capitalized, have high liquidity. That's the upside of what happened and the lessons that we learned through the great financial crisis. So I think there could be issues out there. Clearly, if you're in the leveraged finance part of major New York investment banks, you're a little nervous after the two most recent incidents, Citrix and Brightspeed, and you're looking at Twitter, you're going, oh my God, can it get any worse than this? But I don't think that threatens overall financial stability. I think we'll get through this.
Explain to our audience the path from worries of liquidity to worries of solvency in this strange word, trust. You and I have lived this. I know I'm getting the liquidity line. Things are wonderful at a given Swiss bank, but from liquidity to solvency is a dangerous path.
It could be a dangerous path, and again, that's why I think on a regulatory basis, a lot of the financial institutions have a lot more liquidity than they used to. It was forced upon them, often against their will. It's for times like this. But yes, you're absolutely right. If your counterparties won't trade with you anymore, if your depositors start removing their assets from your balance sheet, it can feed on itself fairly quickly.
You get in trouble with the general counsel of DWS, but do you feel that Swiss regulators are lacking because there's only two major banks there?
I think it's an issue that they've got to deal with. It's not something that they can change on their own. It's the world in which they live.
There's a larger point, too, when you say that financial stability issues are not going to be the same as they had been back in 2008. How much does that take the sort of pivot off the table, that Fed officials aren't going to necessarily back off what they're doing because they're not going to break the financial system in the way that some people are suggesting they could?
Lisa, you've been talking about this for several months now, and we've been watching it very, very closely, and I think it's something you want to be concerned about. We saw it last Wednesday, right, when the Bank of England had to step in to try and stabilize the gilt market. And I think that there's a concern in the broader financial markets that something might happen within the U.S. markets, given limited liquidity, given some of the non-bank financial system growth that we've seen, that something like this will happen, and the Fed will immediately have to pivot from QT and go back to QE again. It's always a possibility. I think that they really don't want to do that, and I think they'll be far more resistant to enter into the marketplace to try and stabilize than they would have been in previous periods.
We were just speaking with the general director of WTO, and she was talking about how the uncertainty has shifted to this sort of downward feeling in the range of outcomes. How are you positioned? Because it seems like you kind of are in that camp. How have you changed your positioning over the past few weeks?
We have been in that camp for quite some time. We've been cautious very much on credit risk. We've been cautious on interest rate risk. But before this rally of the past couple of days, going into the end of the third quarter, we were actually starting to engage the market, seeing some real value, for example, in shorter duration treasuries, when we can invest for our investors at 3 or 4 year treasuries north of 4%. We think that's a pretty good place to hide out. We actually have been engaging in the mortgage-backed securities market. Fannies and Freddies. You've got 5.5% coupons on 30-year mortgages that were trading below par. I mean, that gives you a good running rate of income. You don't have to worry about credit issues. Liquidity is really good. You've got convexity risk, but we're willing to take that now because with high volatility, you're actually getting paid for that optionality that you're writing. Not going in whole hog, but stepping in piece by piece.
Triple C, unsecured debt? No?
Not yet.
Connection
lost. Not yet. Not yet.
Just asking for a friend.
I understand.
Just trying to work out if we can finance a deal. Thank you very much, sir. Greg Staples there of DWS Group. You hear that from a lot of people in fixed income, don't you? I mean, I think they know what I'm talking about, but the response I usually get is, no.
Yeah, well, I mean, and Greg was pretty honest when he said, you know, banks wake up and they're just not happy. I mean, how could they be happy with this?
Will Twitter be triple C?
The unsecured portion of the debt was rated triple C, yeah.
Yeah.
Okay.
It's going to be difficult, Tom. I think that runs at about 15%.
15%.
Yeah.
The yield on that right now. I mean, I don't know what that one goes for.
That's even
but
higher
on
than
average
what
right now.
Warren Buffett demands. He's like 8% preferreds.
Basically, the point is they're going to charge an arm and a leg to get this deal done. And whether this is something that's going to really be valuable for him to go through with because of X, the Everything app, we'll have to see. And I think that's really the gamble that you're seeing in stock markets right now.
Dumb question. Is this discovered today or like
No,
tomorrow?
we knew this back in April, if that's what you mean, Tom.
But it's worse now, right?
Sure, much worse over the last several months. Much worse for the banks, to be clear about that, Tom. Much worse for the banks.
Because they committed to financing at rates that were much lower. So if they sell it, they have to sell the debt at a huge discount, book losses. And this is the concern with bridge loans, not from a financial stability point, as Greg was just talking about, but from the perspective of their earnings are going to get hit yet again in an environment where deal making is already slow.
Further dumb question. If they made a commitment back in April, does that commitment stand now, or do they rip it up and do a new agreement?
I don't know the answer to that. And I'm going to wait to see what the banks have got to say.
Fair.
I imagine if Elon Musk wants to make this deal happen, then he would be a little bit annoyed. I don't want to get into the litigation of what would happen.
Yeah, that's the issue.
Does he know that I delete every single ad in my feed? I block them. I block them.
Blocking them is how you do it.
The only one I don't is Arsenal Soccer. I don't delete the Arsenal feed.
Do they give you promotional ads?
Yeah, I get promotions from Arsenal.
Know that.
Yeah, Queens Park Rangers.
I just don't want to get into the litigation around the banks and Elon Musk right now. I think I'm not qualified to go there.
Either of them.
And that's probably the better way of putting it.
Us.
From New York City, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. You heard about it. Elon Musk's decision to revive his $44 billion takeover of Twitter is great news for a number of investors. They include billionaire Carl Icahn and arbitrage traders who continued to bet on the outcome of the deal through months of uncertainty. After Musk said he would move forward with the agreement at the original offer price, Twitter's stock rallied as much as 23%. The Biden administration is trying to keep OPEC and its allies from making the biggest cut in oil output since 2020. OPEC Plus is meeting today in Vienna, where energy ministers will consider cutting production by as much as 2 million barrels a day. Bloomberg's learned that U.S. officials are making calls to counterparts in the Gulf, trying to push back against the move. Mortgage rates in the U.S. rose for the 7th week in a row to the highest in 16 years. According to the Mortgage Bankers Association, the rate on a 30-year fixed mortgage rose nearly a quarter point to 6.75%. Rising mortgage rates led to an almost 14% decline in applications to buy or refinance a home. In Denmark, Prime Minister Mette Frederiksen has called for general elections November 1st, 7 months before her term ends. Frederiksen was pushed into calling the vote by the opposition. In July, she was reprimanded for her role in the culling of Denmark's entire 17 million mink population during the pandemic. The government was concerned the animals would transmit COVID to humans. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect. How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
From New York City.
In London, in Sydney,
in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
How
story.
are you thinking about those dynamics?
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
Such a cap on gas prices must be designed properly to ensure security of supply. Introducing a cap on gas overall is a temporary solution until we will have a new EU price index developed that ensures a better functioning of the market.
Ursula von der Leyen then, the European Commission President, energy, the main focus for us this morning with OPEC Plus meeting imminently in Vienna, Austria, discussing potentially a cut to output of somewhere between 1 to 2 million barrels a day. We'll get to that in a moment. Let's whip through the price section for you on the S&P 500. Last 2 days, big two-day pop. This morning, down 0.9% on the S&P. Yields up, higher by 6 basis points, 368.88. Dollar stronger, euro dollar negative 0.75%, and 99.11 on euro dollar. Call it 99.10. Crude down 0.5%, $86.12. Tom, do we have the video of Aaron Judge?
I don't think we have the video, but we have the tweet.
Smashing it out of the park.
We have a tweet. Oh, we have a presidential tweet that is important.
Congrats.
At the Judge 44.
That was emphatic, wasn't
History made. More history to make.
That's nice.
There's 10 hours ago from the President of the United States. Phillies fan. Philadelphia Phillies fan.
Of course, that would make sense.
That would make sense.
Delaware doesn't have a baseball team?
We'll have to see. Aaron Judge doing it again with a few days to go. We speak with Yankees fan Anne-Marie Horton. Very quickly, Anne-Marie, there's some serious stuff to talk about. A big moment for the Yankees and their lore.
Yeah, huge moment. Look, I'm looking at I'm reading the New York Post this morning because every other newspaper
nice on radio. That looks great,
didn't want to cover this, and especially not, hometown paper, Washington Post. You could take the girl out of New York, but you can't take the New York out of the girl. 62 home runs. Can we just say he bet on himself? The Yankees offered him an extension for nearly $215 million. He's a free agent.
He's a free agent.
But how do you lose him now? How do you lose him now?
You do him for a lot of money to Steve Cohen and the New York Mets. I mean, that's what this is, where this is working out. Anne-Marie, we got too much news flow.
He's not going to Queens.
Anne-Marie,
He's not going to Queens.
The New York Times with a great article about gas, from $5 a gallon down to $3.67 a gallon. Let's cut to the chase. Does the price of a gallon of gas in these OPEC meetings, does it matter to an election in Pennsylvania?
Well, it does matter in terms of if you see an oil price spike, that at some point will trickle down to gasoline prices. And obviously, that is one of the biggest concerns this administration has been worried about. You saw that with SPR releases. You saw the fact that at some point they were tweeting about it, Ron Klain, the president's chief of staff, almost every day when you saw the numbers start to trickle down from that $5 peak in the middle of the summer, which is why this OPEC meeting is optically very difficult for the administration, right? We are a month out from the midterm elections, inflation, gasoline prices. This is something that has been really difficult for the administration to deal with and their communication on. And now you have one of their main allies in the Gulf pushing for potentially a 2 million barrel a day cut. For some context, a 2 million barrels a day cut is 20 times more the amount of oil Biden got after his Saudi trip, but in the other direction. But there are caveats to this. A lot of these OPEC countries are not reaching their production quotas, which is why I wouldn't say the White House right now is panic-stricken. Maybe they're just slightly disappointed with the timing.
So, MH, there's a couple of options on the table. You get on the phone to the Crown Prince, you try and work something out, option one. Option two is you keep leaning heavily on the SPR. That was set to fade in the last month or so. Or option three, you consider something they've been floating for much of this year, which is do something about restricting export of crude product. Can you tell me where we are on all of those options?
Well, obviously, option one, we have not seen a phone call yet directly from the president to the Crown Prince, but to his key advisors that deal with energy and the Middle East. Brett McGurk and Amos Hochstein were recently in Saudi Arabia, so I imagine energy prices was discussed. When you look at potentially stopping exports out of the United States, while yes, this is gaining a little bit of steam in some parts of the administration, at the moment it just seems to be an idea, a tool that they could use. But many in the administration are also well aware that if you do that, that just increases prices globally and potentially could backfire.
Well, but Anne-Marie, there's a larger issue here, which is how firm is the commitment that the U.S. has made to European allies to support them through a winter that, by all accounts, is expected to be difficult?
Well, they're trying as best as they can to send over liquefied natural gas, and it's a record in terms of what U.S. producers are sending over to Europe in liquefied natural gas. I mean, the president and his advisors have made it clear that they will do, quote unquote, whatever it takes really to support Europe. But the issue is, obviously, is Europe is just not set up infrastructure-wise, and it's not really this winter, right? You had Ursula von der Leyen, I believe today, talking about the fact that they are 90% in terms of storage for LNG and natural gas supplies. It's next winter that's going to be the big problem.
Well, but even with LNG, right, I mean, the exports there, we heard from Secretary Granholm some issues earlier this year about even restricting those, right? I mean, that the U.S., yes, is supplying as much as they can to Europe right now and has increased dramatically those exports, but this isn't politically bulletproof. How much is the White House trying to make this politically bulletproof to secure the alliance, really, between the United States and Europe?
Well, at the moment, the U.S. can only do as much as it can, which is sending over, and these private companies sending over liquefied natural gas. Obviously, if there was export controls, you're going to hear a lot of complaints, I imagine, and phone calls from European capitals to Washington. But they're looking elsewhere as well, obviously in the Middle East, which has very much so these producers' long-term contracts with individuals in Asia. But what you're getting at, Lisa, is the fact that what we're waiting for potentially, or what we can potentially see, are cracks to the unity that the United States has really worked hard to make sure they're securing with Europe. But I would say what we have seen recently coming out of Russia, which is this rhetoric, these sham referendums, this annexation, that very difficult to find a country that believes the fact that they don't even know what territory they annex because the borders keep moving. And then obviously Putin saying that he potentially would use nuclear weapons, that has only brought these allies closer together and realize that even if it's going to be a tough winter, it may be worth it.
Did you bring the Yankees jacket to work? That's all we need to know. Where is it? Are you wearing that around D.C.? There it is.
Of course.
And you know, she was going to get the Gucci New York Yankees jacket, but went with the American Ralph Lauren statement. You know, it's
well, he's from the Bronx, so yeah, Grand Concourse.
Okay. Well. Anne-Marie, thank you.
Lisa, comments here on the Yankees' triumph?
Well, wait till the Mets buy him.
Oh.
Sorry.
There's that love.
Well, I mean,
is that Anne-Marie's? Thanks for coming on this morning.
Anne-Marie, thank you so much for coming on. I mean, come on. You know,
is that where you think this is going?
You mentioned Stevie Cohen. You know, it depends on how big the paycheck is.
That is true. That is true. Can I tell you the one strange thing for a foreigner? Someone that actually does like the Yankees and Aaron Judge, and congratulations to Mr. Judge, of course.
So diplomatic.
I have to say that I found it so strange that the way this is presented and has been chased over the last couple of weeks is almost like Barry Bonds didn't even exist. Well, it's kind of bizarre.
That asterisk is toxic.
Well, it doesn't even get discussed.
It doesn't get discussed because people can't say, it's not very graceful to say, well, yeah, there was Barry Bonds, but he was
you can't say it's never
kind
been
of
done
juiced.
before when it's been done before.
But has it?
Physically, yeah.
Well, right, but like in technical terms, has it? Tom's just like,
yeah, kind of. It has.
How do you guys think I keep doing this? I got steroids in my tank.
Right? I mean, it has, but it has it.
Yeah.
Oh, the tank is good.
From New York, this is Bloomberg.
Successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as started out a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
Today's CFOs are reshaping the C-suite, breaking out of traditional roles to become Chief Future Officer. Global logistics is complex. It takes plenty of capital and plenty of focus. Deutsche Post DHL Group CFO Melanie Kreis makes sure her company has both.
My role is essentially saying what is working well in this company, where do we have challenges, and what should we do going forward.
Chief Future Officer, today on Bloomberg. Brought to you by Workday. From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays, this is Bloomberg. A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Inflation is more embedded, and therefore the policy response has to be still focused on inflation.
Core inflation is around 5.5% to 6.5%. That's where wages are. That's got to come down for the Fed to eventually pivot. Until that comes down, I don't see a Fed pivot.
Really what the Fed is looking for is signs of a loosening labor market, and I don't think we get that quite yet.
This all feeds into the Fed not being happy where things are, and this softness in US yields, I don't think it will last.
The market is sniffing out the sort of top of the Fed cycle. I think bond yields have overshot and are now coming down.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. An eventful, 50 minutes away, eventful Wednesday, ADP Wednesday, coming up here. The first look at the American labor economy. John, on to that report on Friday.
The Romanian central bank just blinked. Only went 25 basis points. It's a joke. Base rate 6.25. The estimate was 6%.
Really? Come on.
We did it with the RBA earlier this
know.
week. They only went 25. Anyway, no, they've lifted the base rate to 6.25. The estimate was 6. I imagine maybe they meant more than that, so we can bring that central bank decision a little bit later. Who would have thought I'd butcher the central bank decision out of Romania? Anyway.
Well, you did better than I would have. The LEU, the dollar.
They actually went, for anyone following this, they actually went 75 basis points instead of 50. So Romania didn't blink.
They didn't blink.
Is that the end of the Fed pivot now?
Yeah, that's it.
Because
We can basically say
Romania went 75.
they're the new front runner.
But can I just say, the reason I say this is because I thought the RBA decision yesterday was ridiculous. Just the idea that the RBA's only gone 25 instead of 50, and that's setting the stage for every other central bank to go less than expected.
But then Jolts,
silly.
Big, 2 days up big, and there's a huge now what Wednesday to
Jolts was more important than the RBA.
Yeah.
I'll go with you on that, without a doubt. Lisa, dropping more than $1 million, telling you that perhaps this dream that we've been talking about for months, you can get job openings down without sending unemployment surging. Maybe it can happen.
And here comes the flood of cold water delivered by me, right? So Andrew Hollenhorst just putting out, this is hardly conclusive evidence that labor demand is waning rapidly enough to bring down inflation, or that the Fed is closer to achieving a soft-ish landing. Basically talking about how perhaps people have gotten over their skis. And I think there's some validity in that, right? But the issue is the fact that the market was poised so dramatically, Tom, for some sort of reversal highlights that people are still playing by the same playbook at a time when inflation has changed the game.
The data does not give us much indication here, but how important is this report in 12 minutes, John? Exactly.
ADP.
The new ADP.
ADP drives me nuts because we all sit here and say ADP is useless, and then for some reason someone trades on it. And then we get payrolls and we clear things up again. I don't think you can make a big call on the labour market just yet. Certainly we've seen jobless claims come in sub 200K. You've seen job openings drop by more than 1 million. And if you're hoping and praying, dreaming about a soft landing, that speaks to that. But you want a more complete picture. I'd be looking to see whether those job openings have come down because there's some heat coming out of this economy, or just because they got filled. People stepped up and hired a lot of people, and we'll look out for payrolls Friday for some of that, I guess.
Lisa, an update on OPEC, please.
Well, we're looking to see what they deliver and why they deliver it, right? I mean, basically, how much are they going to end up cutting 1 million barrels or 2 million barrels because they just don't have the ability to
Do we see that like this hour? Do we see this morning, John? Do we see it in your 9 o'clock
Usually,
hour?
what the OPEC Plus decision, Tom?
Yeah.
Usually you get a kind of leak from delegates of what they're going to do before they seal the deal. Yeah, potentially in the next couple of hours. JP Morgan published a moment ago, and they said the following: OPEC Plus looking to cut production with or without an agreement. I think that's interesting. They go on to say all to retest $100 a barrel in 4Q. That's been a long-standing target for them.
Paul Sankey with some video out there on the streets of Vienna. Menace Cranny, of course, staying on tune with the story. Let's go to the data right now, John. And to me, it's sort of a clumsy day of data. I guess I'm going to say yen 144.48. We're just not where we were, the excitement of the last 2 days.
When you've had a monster two-day pop on the S&P, the biggest going back to April 2020, it's unsurprising, I think, to see equities lower today by 0.9% on the S&P, and yields higher. If I can tell you where equities are, you can usually guess where bonds are. So if equities are down, yields are probably up, and they are by 6 basis points, Tom, to 369.68.
86.46 on West Texas Intermediate. Brent crude, I'm going to round it up to $92 a barrel, and of course we'll pay attention to what we see from OPEC and what it means for your gallon of gas. Brian Nick right now, Chief Investment Strategist at Nuveen. Brian, what at the margin have you changed in your call to year end, and far more importantly, to get 6 months out in 2023?
Yeah, I think that time horizon is really the trick. Thanks for having me on. The strategy that we've sort of employed here is to assume it's going to be sort of the same 1 step forward, 2 steps back type of market environment. And so we've opted for sort of a muddle through approach in our fourth quarter outlook, where we're sort of playing the middle. We like yield. We like less interest rate sensitivity. That's drawing us to real assets like farmland, but also in the public markets to things like high yield, which has hung in there pretty well in the third quarter and then the first 2 days of the fourth quarter now, because it's traded off so much and it has that nice cushion against a further rise in interest rates or a further deterioration in the economic outlook.
Brian, you took us into the weeds, so let's stay there. Farmland. I often hear that from certain people on programs like this, and if I'm sitting at home thinking, how on earth do I get exposure to what Brian's talking about? I don't have the money to buy acres and acres of farmland. Brian, how are you offering exposure to that?
Well, that's going to be mainly in the private markets, as you say. So I was trying to give an example of one, each public and private. But we're trying to sort of democratize these asset classes and try to slice and dice the minimum holding sizes enough for things like especially real estate, but I think increasingly farmland as well. So investors don't have to have tens of millions of dollars in their portfolio in order to justify or to have access to a piece of farmland. A broad commodities exposure, which includes some of the agricultural output that this farmland will create. It's not quite the same type of investment, but that's also available for people who don't have that huge portfolio size. But again, it's really about finding what's going to work in a persistent high inflation environment where interest rates are whipping around and there is increasing concern about what's going to happen to the economy again in that 3 to 6 month time horizon.
John, I was thinking the same thing. How do you get scale in farmland? You just go buy North Dakota?
Money. You need money.
I mean, really. But there is this issue, Brian, where you also deal with the liquidity of farmland, the liquidity of real estate. Not so great compared to the liquidity of, say, full faith and credit of treasuries. How do you offer individual investors the access to this when there is a liquidity mismatch at a time when this is of high concern to a lot of people? What if the economy turns on a dime, and what's the consequence of that liquidity mismatch, which has often caused some serious problems?
Right, well, there's two types of liquidity. There's the actual investment vehicle that prevents you from pulling money out in a rapid way because it has to be deployed in a deliberate fashion. So that is going to be, again, an entirely different type of investment in a private market where you're not going to have daily liquidity and not daily price discovery either, which for some investors can be a good thing. If you don't see the value whipping around because nobody's assessing it, it can actually help you with composure and maintaining long-term investment strategies. Then there's the liquidity that we're seeing challenged, yes, even in the treasury market. The TIPS market has been rallying the last couple of days, I think because some liquidity has come back in, not because anything special is happening with inflation expectations. So TIPS had a pretty tough run, correlated, I think, to some of the financial concerns around the UK and the general lack of liquidity in the market. So those had sold off. So you have like this tactical liquidity risk that seeps in and out of the markets depending on the environment. And that's the one that I think we're going to have to keep a closer eye on in all of our portfolios as we move into the end of the year.
How has the marginal buyer of treasuries changed over the past 9 months, especially as you see, for example, Japanese investors have a less optimal value proposition just based on a currency hedging kind of basis?
Yeah, well, I think the official stats indicate that there's still a lot of foreign demand for U.S. Treasuries. That's part of what's supporting the dollar, is that there's people around the world who are not getting as high an interest rates, especially real interest rates, as they can get in the U.S., and that's attracting a lot of people into the U.S. dollar and into U.S. Treasuries. We're continuing to see demand from, I would say, lower yielding parts of the world, even for our municipal portfolios, which don't offer any tax advantage to people who are not U.S. residents, U.S. citizens. We still have demand because municipal bond yields have traded up considerably this year, too, from places like Korea, Japan, where the domestic interest rates are still quite low. So I think the demand is still there. Clearly, there's going to be some concerns with the actual exchange rate today and how difficult it is for investors to hedge, as you point out, and to get into the dollar at these very strong levels. But I think over the course of the year, as you've seen rates moving up, the demand for dollars and demand for treasuries has been quite strong.
Brian, just quickly, what do you want from payrolls on Friday?
200,000 to 300,000 would be great. The ADP number this morning is going to be interesting because they just changed the methodology, and that has been showing a sequential decline akin to what we would expect to see in a slowing economy, whereas the payrolls number really hasn't been showing that. The JOLTS number yesterday was, sort of like, yay, there were fewer job openings, but to your point, it's not clear if those have been filled or if those are just people slashing those job openings. The only reason we're paying attention to them, I think, is because Jay Powell has said it's important, not because we think there's some great amount of information in the JOLTS numbers compared to, say, the payrolls number on Friday. So
next time,
200,000, no change in the unemployment rate.
Next time we take the show on the road, I'm going to Nuveen for some live reaction of data. Just yay on payrolls Friday.
Yeah, right. That's exactly what we wrote.
Hey, Brian, thank you. Brian, Nick, and Nuveen. TK, yay?
Yeah, yay. I mean,
yay.
We got different ways to go here, and we can go to the farm thing in a minute. Here's Will Kennedy leading our coverage.
What did Will say?
On Vienna, and it's a really important point. Alexander Novak, Russia's deputy prime minister, just arrived. Quite a moment to see such a high-ranking Russia official arrive in a European Union capital, Vienna, as war rages in Ukraine. That's not a small moment.
This is what Manus mentioned earlier this morning. And we're set to have a conversation now about a 1 to 2 million barrel a day output cut at a time where this White House wants to see completely the opposite.
I don't think the White House is part of the dialogue, are they?
Right now, at this meeting,
they're not fist bumping with Mr. Novak or Russia.
Clearly not. Clearly not. But they were fist bumping with the Saudis, and I would say the Saudi vote on OPEC Plus is a bit bigger than everyone else's.
And how much is the U.S. really the elephant in the room here, sort of with respect to the alliance of OPEC Plus with Russia's presence at a time when the rest of the world is looking for even lower oil prices?
Looking forward to the outcome of this decision in Vienna, Austria. An in-person meeting that could go on long within 13 minutes, I'm told. And an ADP report just around the corner. Mike McKee is going to sit in the chair and say yay as it crosses.
Yay.
Live from New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. OPEC and its allies may make their biggest cut in oil output since 2020. The move to stabilize prices risks cranking up tensions with the U.S. At their meeting in Vienna today, OPEC plus energy ministers will discuss cutting production by as much as 2 million barrels a day. Now, that could lead to higher gasoline prices for U.S. drivers. Prime Minister Liz Truss warns that the UK faces what she calls stormy days. Truss spoke to the Conservative Party conference in an attempt to get her beleaguered government back on track. She says she's determined to break out of the high-tax, low-growth cycle, and that tax cuts show that Britain is open for business. Protesters said to be from the environmental group Greenpeace. They only briefly disrupted Truss's speech before they were escorted out. The world's richest person has found a way to potentially avoid a bruising courtroom battle. Elon Musk has revived his $44 billion offer to take over Twitter. Now, that proposal likely eliminates the need for a trial over whether Musk should be forced to go forward with the purchase. Bloomberg's learned that Musk's legal team sensed that the case was not going so well. The European Union has backed off a new set of sanctions on Russia. Bloomberg's learned it includes support for a price cap on oil sales to third countries. The sanctions also target a range of individuals and entities, including senior Russian officials and those involved in staging the recently widely condemned referendums. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
When the price of anything goes up, the consequences reach far beyond what you'd expect. But perhaps most of all, when it comes to food. In 2010, surging food prices helped spark the Arab Spring. Lives were lost, regimes fell, and the consequences are still with us. Once again, food prices are rising, and fast. Energy costs, broken supply chains, and surging demand were just some of the factors that have driven food prices to their first record high since the Arab Spring. And that's all before a war between two of the world's biggest food producers. Ukraine is called the breadbasket of Europe, and taken with Russia, the two account for about a quarter of global wheat trade. They produce more than half of the world's sunflower seeds and oil, nearly 20% of the barley. Now throw in rising energy prices, and processing, transporting, even refrigerating food gets more expensive. Plus, fertilizer production is extremely energy intensive. Less fertilizer means lower crop yield, and prices rise even more. The pandemic revealed how complicated and fragile global trade systems are. Global agriculture, perhaps even more so. Unlike metals, for example, food goes bad. And crops take months to grow and are vulnerable to unpredictabilities like the weather. Rising food prices will be felt everywhere, but the poorest countries in the world will be hit the hardest. And as all these factors compound, the real fear is that record high will lead to record high, and ultimately to a global food crisis with vast consequence.
The markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
Those numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close, weekdays on Bloomberg.
We will never break. Build on a foundation.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Right now, the pain that I hear every day, the suffering that people tell me they're going through, is on the inflation side. If we let it go, it's a corrosive disease. It's a toxin that erodes the real purchasing power of people.
Mary Daly there, the San Francisco Fed president, live from New York City this morning. Good morning. Futures lower on the S&P by 0.8%. Some data from ADP. Let's get to Mike McKee for more. Morning, Mike.
Good morning, John. And this may be good news. We don't really know because ADP has changed their formula, and we don't exactly know how it translates into Friday's numbers. But 208,000 jobs on the ADP payrolls creation during the month of September, and that's up from the 185,000, which is the revised number for August. It is sequentially lower, as Brian Nick was talking about, which is what the Fed kind of wants to see, and I guess therefore the markets want to see. But does it tell us much about what private sector job creation is going to be for the month of September as far as the government payrolls numbers? That's hard to say because this is only the second month that they've done this. Most of the jobs created in the medium-size company category. We did see 13,000 manufacturing jobs go away, which kind of is in line with what we saw from the ISM numbers, which fell below 50 this week on the manufacturing numbers. So we'll see how much validity this report has for Friday.
Mike, no big moves off the back of this in the market. Can we pick up on a data point that came out a little bit earlier this morning? Mortgage applications down by more than 14%. Your reaction to that?
I'm not surprised, but what it does look like is a real pullback very quickly now in the real estate business. Some people say, you know, when you see a number like that, you think maybe it's a seasonally affected number, but this could be real because of what's happened with mortgage rates going up so high. And it just means that the real estate sector has already rolled over from Fed rate increases. Now, does that mean it goes into the rest of the economy? And how fast does it bring down rents? Very interesting Connor Sen column today. That
he's fantastic.
A new report, and this is on the Bloomberg, a new report from an agency that tracks rentals says that rental prices are falling because far fewer people are renting now, and this could be the first sign
Where are they
of a
living
drop.
if they're not owning houses and not renting either?
Have you been home to your apartment lately? Apparently the idea is that household formation has dropped off.
Yeah.
And it skyrocketed after the pandemic. A lot of people came out and got out of their parents' houses and got married or moved in with somebody, and now that's not happening.
Okay, well, link this together for our viewers and listeners. Another headline, as John mentions at the earlier this morning data, mortgage rates are back to 2006, 6.75%. I saw another headline, spurious, Toronto home prices down 17%. How bad is this going to be? What's your judgment after you and I living the wars of 04, 05, 08 collapse?
Well, I was one of the people who thought that we would not have a national housing collapse in 2007 because it had never happened before. I've learned my lesson.
Mark Pittman taught us that well.
I won't say that is going to happen, but it does seem that we are starting to see prices fall, which would then feed into the CPI numbers, and it takes time, but if they fall rapidly enough, maybe it will get into the numbers more quickly, and then the Fed may be able to back off sooner. But as we've seen in the United Kingdom, there can be a lot of financial stress that we don't know about out there.
Well, which goes to the financial stability issue, which we've talked a lot about. Will this cause the Fed to potentially pull back from some of the rate hiking? We heard from Eddie Ardeni saying that financial stability is going to end up more front and center than it has been, and possibly even supersede the inflation discussion. Where do mortgages fit into that?
They fit into it in a sort of very fundamental way, in the sense that the housing industry is the biggest in the United States overall, and the biggest input into inflation numbers, the CPI numbers. And so when that goes up and down, it has an effect on the economy. There's a separate line item in GDP for residential investment.
We've been talking about this, and Tom Porcelio over at RBC raised it in real full. This discussion of, is the labor market the accurate gauge for the Fed to be looking at to understand how much they're taking some of the heat out of the economy to achieve their inflation goals?
It's been the traditional way. It's been a Phillips curve economy. People look at the trade-offs between inflation and employment. They don't know whether inflation dynamics have changed, so they're still looking at the labor market, but they admit there's a lot of questions about how you can tell what's happening to the economy. This is a nerd show, so I feel comfortable saying this to you guys. I raised this with another reporter this morning who went, I don't know. Our star is the new concept here.
Okay.
A paper was presented at the New York Fed Financial Stability Conference on Friday that there is a level of interest rates after a long period of zero rates that you start to have financial stability problems, and that rate is below the neutral rate. So the Fed is going to have to fight financial stability problems before it can get to the neutral rate. I don't know if that's true, but it's getting a lot of
Has John Williams done a paper on that yet?
John Williams has not, but it was presented at his conference. Now, he did the R.
There we go.
He does the R star calculation. We don't know exactly what R star is.
It's actually really interesting.
I thought it was a cut on David Bowie's last album, Lazarus.
But this is fascinating. This basically saying that they cannot allow yields to go up to where they would naturally go based on inflation and growth because of the amount of debt that has been incurred over the past few decades, that it blows up the financing system as we know it in a way that's too disruptive.
Mike and I are going to be at IMF. There's the blue book, the green book, the brown book. Guess what? Every 9 years, the green book matters. That's where we are.
It sounds like QE forever, that Mike McKee.
Yeah.
On a serious note and a serious question, I've asked this of a few people, Mike. I'd love your insight on it. QT at the Fed, how much longer can that go on for?
They don't know. And the only way to find out is essentially to break something. They get to a level where there's some financial disruption, and there's a big discussion underway about how far they can go. The financial system is kind of messed up right now. There are regulatory issues, supplementary leverage ratio, things like that, that kind of make it hard to know exactly where they're going to go and how fast they get there.
Lisa, is it a choice between financial instability or higher inflation for longer?
Well, and this is the issue, right? Because if they have essentially end up buying bonds, having quantitative easing at a time where they're also raising rates so that they can cut off inflation, do they end up cutting their nose off to spite their face?
Bank of England last week, right? The financial stability concerns, Mike, on the one side, and then the MPC is going to meet on November 3rd, Tom, and perhaps hike interest rates big time.
It's all original. Mike, how original is this, and what are you looking for jobs on Friday?
I would say I'm looking for the sequential decline. If you're looking at something between 200 and 300,000, I know Brian Nick said this just a few minutes ago, that would represent the kind of decline, gradual and not too harmful to the economy that you're expecting. If you get a really high number, then that suggests our star comes back into play because the Fed has to raise rates higher. And then that's going to scare everybody in the markets. I'm glad I brought that concept.
Thank you.
I am too. Our star.
Did you do what Brian Nick did yesterday and just say yay when job openings came down 1 million plus?
He was right. It's just a marker along the way.
Live from New York, this is Bloomberg.
doesn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
Connection
I've
lost.
been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Material samples brought back from objects in space can shed light on billions of years of our solar system's history, including details about the origin of life here on Earth.
A piece of an asteroid is a piece of the earliest beginnings of the solar system.
But picking up rocks from the surface of an asteroid or planetary satellite isn't as easy as it sounds. It requires voyages of millions of miles to bodies that have never been seen up close. Probes need to land on surfaces with weak gravitational pulls, where the surface terrain is completely unknown, gather samples, and then make the long trip back. And while behemoths like NASA and SpaceX grab headlines, it's a relatively young space agency. The Japan Aerospace Exploration Agency, better known as JAXA, that is taking the giant leap necessary to bring the mysteries of space back down to Earth.
When you've had your fill of IPOs, ETFs, and CPI,
tune into the lineup for some NFL, NBA, and MLB. Did you retire too early? I mean, look at some of these payouts.
I absolutely retired too early.
For the inside scoop on sports betting, catch the lineup right here on Bloomberg.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect. How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
From New York City this morning, good morning to you all. Equities lower after two stellar days of gains on the S&P 500. Biggest two-day pop on the S&P going back to spring 2020. We're down about 1% on S&P 500 futures. Mike McKee just won't go away. More economic data. Hey, Mike.
Yeah, we have the trade numbers for the month of August, which will go into third quarter GDP. As trade balance is at negative 67 billion, 67.4. That's down from 70.71. So it does suggest that trade will contribute to growth. The deficit not as big. What I haven't seen yet is the breakdown. One of the questions that's out there is, do we see a big collapse in U.S. exports because the dollar is so strong? And that's what people are going to be looking at in terms of a longer-term implications for all of this, the mix of the terms of trade.
Mike, given how closed off this economy is relative to, say, the UK, how much does that FX story actually matter to the U.S. economy?
It doesn't matter as much for the U.S. economy, but it matters for the rest of the world. I mean, we export our inflation when the dollar is so strong. It means everybody else has to tighten more. So, in a sense, that could blow back to the U.S. We could see too much credit tightening, and then you end up with the greater possibility of recession. So it is a question that will come up at the IMF, Tom, about whether currencies have diverged enough from fundamentals that somebody should at least say something.
Yeah, I got a fancy chart on that we're distant from Plaza. How distant are we from a merchandise trade, summed merchandise trade recession? The WTO statistic today for next year, 1%, was stunning.
Well, those who follow it say we're very close to something like that, and it is decline in global trade that is worrying people because it's a measure sort of how the global economy is doing. And as trade collapses, people are spending less money. It's more of a problem, and it's a problem for the rest of the world even more than us. It's one of the reasons that Australia went only 25 because they're much more exposed to what's going on than the U.S. is.
As people have written in, China for Australia in the way that maybe it doesn't impact the United States. A blink, Tom, a pivot from the RBA, setting a stage for the Federal Reserve.
It is.
Or maybe not. Mike, looking forward to the interview a little bit later this morning. Mary Daly of the San Francisco Fed. Just briefly, what do you want out of that conversation?
We'd like to kind of get an idea of how far can they go? What do they think of this concept of financial instability going forward? I mean, we know they're going to raise rates. We know she'll say, we'll keep them there for a while and we're committed and all that. They've said that over and over again. But what happens when something breaks?
Looking forward to it. Mike McKee, thank you, sir. In about 90 minutes' time, Tom.
Mary Daly,
Mike McKee.
Really, really important Fed president. She brings a resume and a life story that I think is hugely important for the Fed. Also at the Fed and working at the Fed with the Board of Governors for years was Michael Gapin. He's Bank of America chief U.S. economist, truly holistic on our monetary and fiscal linkages. Michael, thank you for briefing us this morning. I want to go, Michael, within the swirl of the data right now to what matters for you. We go to jobs and we go on. We stagger into November. What matters for Michael Gapin?
Honestly, only one number, and that's the payroll number. I think that there's a lot of distortion in the data, as you know, and we've talked about it many times, and it's really hard to know, which one do we take the right signal from? And so what matters to me in terms of the underlying momentum in the economy, how far the Fed may go, and the near-term course of the economy, it's almost exclusively just payrolls.
Well, let's drill into that to payrolls versus the two studies that we'll see on Friday. If I take a 3-month moving average of non-farm payrolls, the number, folks, that comes out at 8:30 that everybody reads first, what is the appropriate 3-month moving average for the Fed to say, all clear, let's change?
To move to a slower pace of hikes, you probably need that number to drop below 200,000. To get a soft landing, that number probably needs to be about 50 to maybe 70. Wow. So I think that it's 275, 300,000 a month. Those are still robust numbers. That tells the Fed to keep going. So pivot to a slower pace, probably below 200. But to get the unemployment rate to rise gently over a 2-year period like they're forecasting, certainly sub 100.
And that's something that is going to be hard to see. That's at least based on a lot of the projections that we've been seeing. Liz Ann Saunders actually put out some interesting charts of Charles Schwab talking about how the data is showing peripheral weakness, that you're seeing more part-time jobs appear in some of the anecdotal data. Is the headline non-farm payrolls number really the one that we should be watching for real-time changes in just how quickly this labor market is softening?
No, certainly there are other data points that are complementary to the overall picture, and I would never say we shouldn't look at those. So the JOLTS data that we received with fewer job openings, the quits rate, the ratio of openings to the unemployed. I think all those are important to provide context. And yes, they do show that on the margin, labor demand is softening and the labor market is cooling, and that's, of course, where the Fed wants to go. But I just think ultimately, the Fed's not going to conclude that the policy setting is right, the outlook for inflation is correct, if we're still adding 200,000 to 300,000 jobs a month. So at the end, yes, it comes down to where payroll growth is, where employment growth is over time, but there are certainly other data points that we should be looking at to see whether or not, are they right that we can reduce labor demand without pushing the unemployment rate up significantly. Those other data points that you mentioned, and including the JOLTS, can help give context around that story.
Mike, there are a lot of people pushing back and saying that inflation is actually decelerating pretty dramatically. They point to a number of different metrics, and they say that looking at the labor market data as it is not accurate. It is a misleading way to create future policy based on a lagging indicator. John's talked a lot about this. Would you agree?
Mm-hmm. In part, yes. I think you do have to be forward-looking in your policy setting. So only looking at the data under your feet at that moment in time may mean that you overcorrect in one direction or the other. And there are going to be other factors that help bring inflation down, whether it's global commodity prices or some reversal in goods prices. So wholesale used car prices being down 7 of the last 8 months, according to Manheim. We should start getting some relief from global supply chains that are going to help the Fed. So it's not just the labor market, and certainly setting policy on where the labor market is today would increase the likelihood that you make a mistake. But in some respects you have what you have, and that's the data point that over time is going to tell them where is services inflation going to end up.
Michael, and this is your wheelhouse from the days I've known you at the Fed, and that is the merchandise trade statistic of WTO today was absolutely stunning. It's a 1% 2023 growth statistic for merchandise trade. Clearly, globally, that does not get it done. What does that statistic mean for Americans?
As you discussed in your prior segment, not as much, because we're a large, relatively closed economy. Strong appreciations in the dollar like we have will slow the economy down through the trade balance. But that's a relatively narrow channel for us. It's certainly not as large as it is for other developed economies like Europe, the UK, Australia, and so forth. And what I would say is what it implies is a very weak global growth backdrop, including outside the U.S., which we all know. And that actually tends to help the U.S. because it brings lower energy prices on net, and gasoline prices fall. So the U.S. gets a windfall on the consumer side, even though a strong dollar and weak global growth is a drag through trade. So it's a more complicated picture when it comes to the U.S.
So, Mike, let's net this out. You've got a recession call on America, on the American economy. Can you just tell me on balance, are you moving that forward? Are you pushing that out? How are things developing?
We pushed it out to begin in Q1. I originally had things slowing down in the fourth quarter of the year, as data earlier this year were kind of pointing to that, but then things picked up here in the summer and the fall. I moved it out to begin in the first half of next year. At the moment, I haven't changed that. I think trends in recent weeks, the Fed shift to being serious and lifting its policy rate, and the tightening in financial conditions that's developed, that's left me comfortable with something around Q1 or in the first half of next year. But that's when we have it starting.
Just to round it out, what about duration and depth, Mike, beyond the start point?
I spread it out over 3 quarters in part to signal a little uncertainty about start, depth, and duration. And we have the unemployment rate rising, a little above 5%, so a little more than the Fed would have it. But I think kind of in the first 3 quarters of next year is when we're likely to see our peak softness.
And the cuts start when, Mike?
December of 23.
This is what's interesting about it, though, Mike. The reason I'm not sitting here saying you've got a crystal ball. That's not why I've asked you those questions. It's interesting to me that you've got 3 quarters of recession and the cuts don't start until the very end of the year, Mike. Is that original? Have you ever seen that before?
So the idea behind that is the terminal rate's about the labor market, but cuts are about inflation. And so when do they shift to a more balanced reaction function? I think, every time inflation comes in higher, it gives them a worse starting point. So it just takes a while for that to show through. But yes, it's consistent with the idea that we're going to have to accept some pain in the domestic economy to bring inflation down. So yeah, it's an odd situation, but it's a Fed right now that's saying we need the economy to slow to help us on the inflation side. So it's a different setting for them.
Fascinating. Mike, just wonderful. It's been brilliant reading your stuff since you got to B of A. It's good to have you with us this morning. Thank you. Mike Apen there of Bank of America. Fold that into the equity call for Savita and the team. This is the issue I think a lot of people have got at play right now in the equity market. There's an economist, and look, you can debate about whether this is going to happen, depth, duration, all of the above. But the base case for Mike Apen is it starts at the start of the year, but you don't get the cuts until the end of the year.
And basically this is saying that financial stability will hold in well enough to allow the Fed to do this, and that will incur a lot of pain, at least if you're invested in risk assets.
Does that sound bullish, Tom?
I think it's original. I think we're making it up as we go.
I'm with you.
It's absolutely original.
Coming up at the Open, looking forward to catching up with Dan Ives of Wedbush on the Twitter deal, on the bond market, Sri Sankaran, Morgan Stanley, Rob Waldner of Invesco, and on the equity market, Sharon Ballard, Goldman Sachs, around the Open in about 2. Tons to discuss in the next hour on Bloomberg TV. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Elon Musk's decision to revive his $44 billion takeover of Twitter is great news for a number of investors. They include billionaire Carl Icahn and arbitrage traders who continue to bet on the outcome of the deal through months of uncertainty. After Musk said he would move forward with the agreement at the original offer price, Twitter stocks rallied as much as 23%. The Biden administration is trying to keep OPEC and its allies from making the biggest cut in oil output since 2020. OPEC Plus is meeting today in Vienna, where energy ministers will consider cutting production by as much as 2 million barrels a day. Now, Bloomberg's learned that U.S. officials are making calls to counterparts in the Gulf, trying to push back against that move. Mortgage rates in the U.S., well, they rose for the 7th week in a row to the highest in 16 years. According to the Mortgage Bankers Association, the rate on a 30-year fixed mortgage rose nearly a quarter point to 6.75%. Rising mortgage rates led to an almost 14% decline in applications to buy or refinance a home. And private sector employers in the U.S. added a better-than-expected 208,000 jobs in September. And that's according to the ADP Research Institute. ADP also said that annual pay was up 7.8% in the last year. The government's monthly jobs report, well, that comes out on Friday. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
What are the moonshots at Amazon that are capturing most of your time and attention?
Well, we have a unique way that we look at big new investments, and I'm not sure it's right or wrong. It just happens to be our way. And we ask ourselves when we're considering something 4 questions. We ask, if it's successful, can it be big and move the needle at Amazon? Is it being well served today? Do we have a differentiated approach? And do we have competence there? And if not, can we acquire quickly? If we like the answer to those questions, we'll go pursue it with a single-threaded team that isn't distracted by the rest of the business.
When it comes to the stock, it has fallen significantly. Do you think investors are missing something, or has tech just been overvalued?
I have never tried to predict what the stock's going to do, and any time I've tried to a little bit, I've been wrong. I do really believe that in the short term, the stock market tends to be a voting machine. In the long term, it tends to be a weighing machine. We have a concept we talk about a lot at Amazon, inputs and outputs, and the ultimate output for a company is share price, and then other big outputs are free cash flow or profit or revenue. You can't really manage the outputs. You have to manage at the input level, and that's where we spend all our time. And so if you do the right things for the business long term, things tend to work out. I think we've had very good returns for investors, and I expect that to be true again.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths.
We're in London, in Sydney,
In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
How
story.
are you thinking about those dynamics?
What we are seeing in our projections is tremendous uncertainty. That I can tell you is what is really making it difficult to predict. We've never seen this amount of certainty when we do our forecasts before. But what we do see is that this uncertainty is tending to risks on the downside.
Ngozi Okonjo-Iweala, she's Director General of the World Trade Organization, hugely qualified to study economics, and she did so this morning with a merchandise trade statistic that was jaw-dropping 1% in 2023, which does not get it done for a global economy, and you fold that right into what we will see in Vienna right now with OPEC. And Lisa, let's mention this. Joining Bloomberg this morning, scheduled the Deputy Prime Minister of Russia.
Who is going to be in Vienna at these meetings in person, a controversial aspect considering that it's in a major European city at a time, as you said earlier, there is a war between Russia after invading Ukraine. How much does that really shape the narrative when it comes to who's on whose side?
In Vienna, our man is Cranny, and again, Alexander Novak scheduled to be with us later this morning. Right now, we do better. I have no idea why he's not in the OPEC Plus meeting at the table. Christian Malik joins us now from JP Morgan, who's really been definitive on the how we get to a permanent $100 a barrel plus. We've seen the demand questions. Ed Morris at Citigroup gaming out nicely, Christian, $70, $80 a barrel, and suddenly we are higher. What is the single distinction that drives us to $120 a barrel?
No spare capacity, in short, Tom. I mean, we're seeing a repricing of oil to the marginal barrel, and it's away from OPEC. I know it sounds controversial to say that on a day like OPEC meeting. It's away from OPEC. It begs the question, what price will they spend? Will they grow their production and reinvest into those long-term projects? And I think we're going to need a significantly higher price, which in some ways is potentially what OPEC is trying to do today. They're trying to defend not only the front end, but the back end.
The trying of OPEC, I have the memory of 1986, oil plunging 24% is my quick mathematics. How close is the cartel to a 1986?
I think in terms of how close they are, that will all depend on how demand responds to the current price. And we know that they're arguably looking for a higher price, potentially closer to where their fiscal break-evens are. Ultimately, it's not just the break-even of the countries, it's also what they want in terms of defending social reform. And we know there's a lot of issues at the moment with high energy prices. So that price level versus what the US wants suggests there's arguably a price war that's emerging between these two continents. But in the end, if demand can respond at 120 to 130, which is our house view, then I don't necessarily see demand collapsing. And then it's all about supply. It's a supply-driven crisis, which is ultimately where our super cycle thesis projects for the next 5 to 7 years.
Where are we in terms of the U.S. as a swing producer at this point, given the lack of investment in the shale patch and just generally throughout the energy sector?
Shale, it's interesting. It's like it's been dismantled. Parts have rusted, you put it back together again, it's just not as effective in terms of productivity, in terms of production volumes, and ultimately they've got used to returning cash and getting more popular with Wall Street. So you have to sort of think about what price do they need to cover all their capex, all their cash return, as well as a price that can necessarily see much bigger volumes of growth with all the money in the world, and that's much higher. That's closer to $80 to $90. So we're not seeing as much volume growth this year, closer to 700, 800,000 barrels, similar to next year, and I think that's the key.
So right now, if you're not seeing production increase and you're actually seeing production cuts at OPEC Plus, where does the marginal stopgap come in, right? We talk about the Strategic Petroleum Reserve and how much the U.S. has already drawn down on some of those reserves, the speculation that they could tap them yet again, drain them further in response to some sort of 2 million barrel production cut today. Is that bullet gone? Is it used?
Absolutely, I think it's used, and you know I love to talk about joules, and the world is short energy, right, across all fuels, and that's what we've been talking through this year and with you. And I think the key here is if the marginal joule, if you like, is oil, then it's a bit like saying to your customers, look, I've got good news and bad news. The good news is I've got oil, still got some energy. The bad news, you're going to have to pay a lot more for it. As inventories come down and that silver bullet from the US is ultimately done, it ultimately becomes who's up for taking those barrels at the higher price.
Christian, in your definitive report of, I'm going to say 7-8 months ago, you give a fair share to ESG, to synthetics, to the other things we're going to do for energy besides oil. Give us your sense of the ESG event, given a war in Ukraine. Is it forever altered? Is it shifted?
I think what we're going to see is ultimately an upgrade of bad co to good co in this sector. And ultimately what I mean by that is this sector, we did some work last week and doing a bottom-up version of that Jules report for companies. And the industry, the European US majors represent roughly 20% of the world's energy in joules, 20%. Across all fuels, not just oil, gas, hydrogen, etc. And so the key here is, I think what this ESG event ultimately will evolve to is more of a hybrid of recognizing the transition is a function of this sector delivering energy on a lower carbon footprint. Is more of a hybrid of recognizing the transition is a function of this sector delivering energy on a lower carbon footprint, but ultimately delivering energy so that we don't compromise security. I think that will change the optics and redefine the sector's role in energy transition as opposed to being simply, in the penalty box.
I think we've lost Christian Malek, unfortunately.
I think we lost him.
Yeah, because it was fascinating to hear.
Maybe that was evil winds from Vienna getting in the way of that transmission. Christian Malek with truly a definitive report, controversial report earlier this year, advancing a theme to higher oil prices as well. Lisa, where do we begin with what's been a completely nudgy day? I mean, it's just a strange day.
It's a pause in a rip-roaring rally that was the best two-day rally in the S&P 500 going back to the depth of the pandemic in 2020. And so this pause perhaps is a reset. It's a moment where people think, okay, is this actually some sort of speculation that we're going to get a softer landing, a soft-ish landing, the labor market is softening, or is this just basically a short squeeze? And that is the nudginess of this Wednesday morning.
Yeah, and we see it in currency as well. And I think, we covered it earlier, folks, and I think it's off the American radar, but I'm sorry, they voted on the trust speech in Birmingham, and the answer is weaker pound sterling, called a 115 level down to a 113 handle. If that trend continues back 3-4 days, there is a signal there of sorts.
And how much support does she have at this point from her own party? I mean, and that to me is what this chart really highlights. The more she spoke, the more uncertainty there was about inflation-adjusted welfare payments, the more uncertainty there was about how this plan would get rolled out, the less certainty there is in the conviction of the pound and the rebound trade. And so how much is that going to become a theme as the months tick on?
And back to OPEC here with a nice lift, a fractional lift, I'm going to call it. West Texas rounded up 87, Brent crude 92. That's migrating to $100 a barrel.
Right now we're looking at an inability to produce, and that seems to be the theme that we heard from Christian Malek. With an inability to produce, what does that mean in terms of where prices go and then demand destruction feeding into a downturn?
An important conversation. Our Michael McKee in conversation with the president of the San Francisco Fed. Maybe those house prices in San Francisco will come up. Mary Daly in the 10 o'clock hour. Stay with us on radio, on television. Good morning.
brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Today's CFOs are reshaping the C-suite, breaking out of traditional roles to become Chief Future Officer. Global logistics is complex. It takes plenty of capital and plenty of focus. Deutsche Post DHL Group CFO Melanie Kreis makes sure her company has both.
My role is essentially saying what is working well in this company, where do we have challenges, and what should we do going forward.
Chief Future Officer, today on Bloomberg. Brought to you by Workday. From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays, this is Bloomberg. A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Kind of like yesterday, upside down. This time, stocks lower, yields higher. From New York City this morning, good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Live from New York City, we begin with the big issue, bear market bounce or the real deal.
Bear market rally.
That is the risk here.
It's good that markets also can turn upwards.
We just did that back in June.
I think any rally is going to be short-lived.
We saw a near-term peak in yields. We saw a near-term peak in the dollar that led to a big rally in stocks.
A two-day rally is pretty normal when you get that peak type of fear from the VIX.
We want to see capitulation.
That feel of capitulation.
The sign of capitulation.
Getting those earnings expectations down is something that we really need to see.
Investors want to hear management speak.
See some companies rip off the earnings Band-Aid.
And really kind of throw in more of a towel.
We think about how long this rally in markets could continue from a stock basis.
There's still some major macro headwinds.
Let's get the conversation started. Joining us now is Morgan Stanley's Sri Sankaran Invesco's Rob Waldner. Rob, first to you. George Goncalves over at MUFG. Fed pivot dreams strike again. Are those dreams going to be realized anytime soon?
Well, they're certainly not being realized right now, Jonathan. I think, we are looking for a Fed pivot to be the durable bottom for the market and really to give us some certainty about, risky assets going forward. We certainly don't see any signs that the Fed has pivoted yet. I think we've had a few sort of little hints that pivots may be in offer. The RBA was a little bit dovish. What happened with Bank of England last week, that probably got people a little bit excited that maybe the Fed might pivot. But they've been very clear that until they see inflation coming down, they're not going to pivot. So I think don't fight the Fed.
Sri, I feel like we've had this conversation 5 different times in the last 5 months. What's your take on it now?
Yeah, I agree with Rob there. I think what really is going to be the key debate is what forces that pivot. I mean, and to some extent, I think the definition of the pivot is also something that we're struggling with. Is it going to be the economic data, which gives the Fed the bandwidth to start thinking about decelerating, then pausing, then pivoting? That to me is like a more positive outcome. if it is a market kind of an accident or a market mishap, more disorderly price action that forces the pivot, that is probably going to be much sharper in terms of how quickly they move. But I mean, these are known unknowns, to be honest.
Well, Sri, I had this conversation with Mike McKee earlier. What do you think we bump into first? Do you think you bump into a pivot that's driven by financial stability concerns before they even achieve that lower inflation outlook?
Yeah, that's a tricky one. To be honest, the hope is that you will still see the data start to decelerate. I mean, obviously the JOLTS and the ISM data to some extent give you that signal, but clearly the negative surprise on the upcoming jobs number and the CPI prints have to be like significantly weaker to kind of remove or change that 75 basis points to 50 basis points in November. We don't think that happens, but it feels like, I mean, the hope is that it's the slowing down of the data that forces that pivot rather than a market mishap.
Rob, your thoughts on that particular question?
Yeah, see, so the problem I have with the way that this narrative is set up by the Fed is that they're looking for inflation to come significantly down. And we know that inflation is lagging. A lot of the inflation that we have now is a result of stimulus from 18 months ago. So I just don't see, I think that the chances of the event being more of an accident and less of a slowing of data, I think is increasing as they stick to their guns on this, set policy based on lagging indicators methodology.
I think it's driving us all nuts. We get 2 days of gains on the S&P 500, biggest two-day pop going back to spring of 2020, and it's pivot on, and then you get a morning of losses, it's pivot off. It's ridiculous. Philip Jefferson over at the Fed, the governor, incoming governor, new governor, had this to say: restoring price stability may take some time and will likely entail a period of below-trend growth. He went on to say, my colleagues and I are resolute that we will bring inflation back down to 2%. We are committed to taking the further steps necessary. Kelly Lyons joins us for more. Hi, Kelly.
Hey, John. So basically saying don't get too excited with this whole pivot idea, which the market frankly has in the last 2 days. The best two-day rally for the S&P 500 going back to April of 2020, as we've gotten a series of economic data points that maybe lended the market to believe that the pivot could be coming. On the one hand, you had that weaker ISM manufacturing data, the kind of softness that maybe would cause some pause on the part of policymakers. And then you had JOLTS yesterday, a million drop in available jobs here in the U.S., those job openings, something that maybe the Federal Reserve would like to see. And then, of course, you had ADP data topping estimates a little bit this morning. We can debate how much of a signal that really is ahead of Friday's jobs report, but that payrolls report and next week's inflation data is going to be critically important, especially as we have seen this revival of the narrative. Although I would note it is changing a bit today, where you're seeing futures heading back down by about 1% on both S&P E-minis and NASDAQ 100 futures, and yields once again are heading upward. And of course, the Fed has given really no indication to believe in a pivot at this point. Not just Philip Jefferson, but a chorus of speakers pretty much every time we hear from them saying the job is not done. We are going to keep going until the fight against inflation is won. And of course, the market seems to believe that they will ultimately go farther, with 75 basis points priced in for November, 50 in December, another 25 early in 2023. But they don't think they will stay at that terminal rate for as long. A cut in 2023 back on the table for this market, John.
Kelly Lyons, thank you. Certainly the terminal rate has been repriced in a big way over the last week or so. I went through the transcript of an interview we did 2 Tuesdays ago with Mike Wilson from Morgan Stanley. Almost eerie what he said and what's played out subsequently. Take a listen to this.
Whatever rates do in the short term can dictate equity prices in the short term as well. And so if we get a rally in the back end, which looks like it should happen from here, then stocks could get a little lift here into earnings season. It's kind of the opposite of the June quarter. We may rally into the earnings season, and then the news is actually worse than feared because companies finally start talking about the risk from currency, the risk next year from a recession, and all those things kind of get priced quickly.
Sri Sankaran, can you share the Mike Wilson crystal ball with us? What are you looking at right now going into earnings season? What are you expecting?
I think the back half of the clip that you played, that is the crux of it, right? So in terms of how much of a downside surprise that we get to earnings guidance, and from the perspective of the credit market, it feels like the next leg of it is going to be about how persistent is that earnings slowdown. To me, it's not really about, if it's a technical recession or a growth recession versus a full-blown recession, earnings recession versus an economic recession. I think these are obviously important elements of it in terms of how it drives the rates volatility. But when we think about the bottom-up credit fundamentals and what drives it, Mike's earnings forecast and the downside that he has versus consensus, that's one. And two, how long that downside persists, along with inflation, or along with rates staying at these current levels, I think those are the dynamics that we're closely watching from the credit lens.
So, Sri, you're saying this is not a binary event when it comes to recession?
Yeah, I mean, we think it's more around, particularly from the lens of credit markets and the lower quality credit markets. If it is a short-lived recession, a jolt, that works in the sense that a lot of the companies should be able to survive that. And if we get into a full-blown easing cycle, that reduces a lot of the pressures. But if we are looking at this setup of slower earnings or low earnings, sub-trend growth, and kind of still elevated rates for a persistent period of time, that's when that feedback loop into fundamentals start to work in a more meaningful manner.
Rob, we'll talk about the credit market specifically in a moment with you, but I caught up with Mike Gapen of Bank of America 40 minutes or so ago. What he had to say about next year was fascinating to me. He basically said recession starts at the start of 23, goes through 3 quarters, but this Fed doesn't start cutting until the end of the year. Now, Rob, I think that's really, really important when it comes to risk, because we're talking about a Fed pivot as if in and of itself it is just bullish per se. But what if we get a Fed pause and no cuts to the end of the year, and a Fed that stomachs, tolerates 3 quarters of negative growth?
Well, that would be obviously very negative for all risky assets, because the headline, your top line growth would continue to come down, your top line in the economy, and you keep those financing rates really high. I don't think the bond market would sit around in that environment, though, and just take the Fed's guidance. I think you'll see the curve really start to invert. I mean, we would actually expect the curve to continue to invert going forward here and see a peak in bond yields, this quarter, even though Fed funds are not going to peak until 2023, because the bond market will see through that and understand that that concept of sticking at a very high rate, even when the economy is in recession, just because inflation is still above your target, won't really make sense to the market.
Bit of breaking news on the crude market, that's for sure. OPEC Plus, the panel recommending a 2 million barrel a day cut to output, according to a delegate. OPEC Plus, the panel recommending a 2 million barrel a day cut to output limit. We're going to hear more about that a little bit later. In response to that, crude elevated a little bit, up 0.6% on WTI, $87 a barrel, up 0.8% on Brent, 92.60. We'll catch up with the team a little bit later. Down in D.C., Bloomberg's Anne-Marie has got some things to say about this, and we'll talk to her in about 40 minutes' time. Wanted to talk to you, Sri, about the price of the story in credit. The price of the story. We've talked about the story, let's talk about the price. When I look at spreads, I see one thing. When you look at yields, I see another. Can you tell me the difference between the two?
Yeah, John, I mean, that is the critical debate that we're having within the credit markets, right? So you look at the spread measures, I mean, regardless of whether it's investment grade or high yield, I mean, these are elevated levels. This is kind of signaling some degree of stresses in the credit market, but nothing that would kind of make the Fed blink or in some ways signal that the credit market is dysfunctional. I think, but when you start looking at the yields, and this is where the investors are also kind of trying to figure out what is the right valuation measure to think about. I mean, all-in yields and investment grade, they're above the COVID highs. On high yield, we breached this only through COVID and also in the GFC and very briefly in 2016. So all-in yields are looking attractive, and prices are also low, which kind of limits some of the downside that you get in a default cycle. But for now, I mean, it feels like we still have to solve for further widening in spreads. And the more important element of the high yield or the leverage credit market is a more functioning primary market is what we need to see. We need to see the clearing levels for risk with deals getting done at those levels. And that was what would give me confidence that we have kind of topped out in terms of spreads. But yeah, yields are looking attractive now, but spreads are not.
Well, Rob, some of these deals aren't getting done. What do you make of market access over the last couple of weeks?
Well, I think this is the big risk going forward in credit always is the ability to refinance. But, we've really been sort of back to the question about all-in yields. We think that the high-quality credit sector is really offering some real opportunities here where you don't have that immediate default risk that you might get in lower quality credit. And actually, if the Fed pivots, you probably do pretty well. And if you go into a recession, you'll like the duration that you have higher quality credit. So, we would stay up in credit quality.
I can't interest you in some CCC unsecured debt, Rob.
Not today. Thank you very much.
Not today. I didn't think so. Rob Waldner, Sri Sankaran, going to keep you both out of trouble. To the both of you, thank you. This is a big story for us, for the likes of Twitter as well, not just on the equity side, but on the debt side too. We'll get to that in just a moment. Right now, the breaking news 5 minutes ago, OPEC Plus, the panel recommending a 2 million barrel a day cut to output limit. Hearing that from a delegate, we'll wait for confirmation from Vienna a little bit later this morning. Futures lower by more than 1%. Coming up, Elon Musk reviving his $44 billion Twitter bid.
Clearly, if you're in the leveraged finance part of major New York investment banks, you're a little nervous after the two most recent incidents, Citrix and Brightspeed, and you're looking at Twitter, you're going, oh my God, can it get any worse than this?
That conversation with Dan Ives of Wedbush up next.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco.
Elon now coming back to the Twitter deal. Now that you're seeing the market recovering, now that you're hearing from other Federal Reserves around the world that they're starting to think about loosening how far they're going to go on interest rates, you're starting to see equity multiples come back. And that also could have been a consideration. As market prices are improving, that also made the deal financially more attractive at where he had agreed to it previously. And there's still a very long path from here until the deal closing, but it certainly seems as likely as it's ever been now.
That's the constructive view. Elon Musk reviving his $44 billion bid for Twitter, dropping one line on the social media platform and tweeting the following: buying Twitter is an accelerant to creating X, the everything app. This coming as Wall Street struggles to offload buyout debt, adding pressure on lenders. Let's get to the Bloomberg team. Ed Ludlow, Sonali Basak. Ed, what happened?
Yeah, we're exactly back to where we started in April. Same offer price, same terms and conditions. The key line in the letter that Musk sent to Twitter was that it needs to be a stay on all legal proceedings. They have to drop their case, essentially. A source told Bloomberg that Elon Musk's legal team essentially looked at going to trial in October, starting on the 17th, didn't fancy their chances. One of the conditions going forward could be that Kathleen St. Jude McCormick, who is due to preside over that case, actually kind of acts as a moderator or adjudicator to get this deal closed. Already questions about how quickly it could close. If you go back to the April 25th agreement, section 2.2 around closing, many of those conditions have been met. Twitter shareholders voted in favor of this deal already last month. The regulatory waiting periods have already elapsed. So where do we move? You mentioned X. All we've heard from Musk is that he's thinking about an app that could be much more than just Twitter as we currently know it, perhaps something like a WeChat, this big picture vision, but we have so much further to go. In its statement last night, Twitter said, we want to close the deal at $54.20 a share. That is all they said. They didn't give us any indication on how they plan to react. We're showing shares of Tesla lower for a second straight, lower 2% in pre-market, but pairing gains during yesterday's session. Why will Musk sell more Tesla stock to fund this deal? What is the element of key man risk here if he's distracted?
Shanali, take me inside Morgan Stanley and how you think they reacted as the story was developing just yesterday.
On one hand, you're happy the deal is going through and that you will get the fees for that deal. But on the other hand, you have Morgan Stanley and a range of banks, John, that could be on the hook for potentially hundreds of millions of dollars in markdowns, given where high-yield debt is trading today and what they promised all the way back in April. Now, the interest rate promise on the riskiest part of this financing was under 12%, and as we know, CCC is trading above 15%. So that is a material difference. And remember, global banks, U.S. banks alone have taken $1.3 billion of the hits in the second quarter alone. If you look globally, that's more than $2 billion, and spreads have really widened out since then. So the third quarter is already not looking good. Scroll forward, because if you look at Twitter, you look at Citrix, you look at Nielsen, you look at Tenneco, and you look at all the deals out there, a source of mine says that the market can be pretty icy here for as long as the next 12 months. Now, I've been testing that idea around the market, and there's a lot of debate around that idea, but really, these large LBOs and the hangover they're creating in the debt markets can be quite the chill here as we look into next year.
Shanali, unfair of me to ask this of you because I couldn't answer this question this morning. Can the banks get out of this?
They can try to renegotiate this, but I don't know how much success they've had negotiating with Elon Musk before.
Makes me wonder, Ed Ludlow, whether this deal can close or not. It's revived the story of yesterday. Can this close?
Yeah, look, I've spoken to a lot of Twitter insiders, employees in the last 24 hours, and frankly, they do not believe that this is an attempt by Musk to close it. They think it's a stalling tactic because he wasn't ready to go to trial. Ultimately, though, the stock reaction that Twitter saw is the market saying, okay, we think this is going to happen. It was the biggest jump since April 4th when he first announced his stake. We're almost at the $54.20 price. We think it will close.
And with Shanali, the debt side of this is the much more interesting piece of it. Shanali Blasek, Ed Ludlow, to the both of you, thank you. Dan Ives of Wedbush has been on a journey following this, raising his Twitter price target to, guess what, $54.20, and saying the soap opera now comes to an end with Musk owning Twitter at the original price tag. For Musk, the irony is the easy part of this deal was buying Twitter. The hard part will be fixing it with monetization and subscriber engagement. We expect the deal to close without any major issues over the next few weeks. Dan, can I pick up on the last piece of that? Why do you think this closes without major issues, given the debt side of the story that Shanali just went through?
Yeah, I mean, clearly there's some debt issues that the bank's going to need to deal with. But in terms of Twitter's board, we believe over the next 24 hours that they take away their lawsuits. And I believe this deal could close as early as next week. Because for Twitter, this was a situation where Musk saw writing on the wall. He knew he was not going to win in Delaware. And I think it's sort of now this old sort of Western standoff now ultimately ends with Musk owning Twitter probably by next week.
If it happens by next week, we start talking about X. Can you tell me what X actually is?
Look, I think that's part of the problem. The easy part, ironically, for Musk was buying this. The hard part's going to be fixing it. The monetization is going to be an ever-like uphill battle. And of course, there could be some subscriber that they could add from a monetization. They could look for more, content partners. But this is going to be just a massive transformation in the next 18, 24 months. And it just comes down our view from the beginning. I mean, this was a ridiculous price that he's paying, but ultimately got locked into it. And with Tesla, I mean, he's essentially selling caviar to buy a $2 slice of pizza in Twitter.
I'll get to the Tesla side of it in just a moment. Dan, who's running this company?
I mean, I think, look, in the near term, it could be Musk, but ultimately he's going to have to farm this out to some social media experience execs because, this is not his sort of swim lane in terms of knowing how to turn around Twitter. But it's part of the problem here. Spread too thin, and that will be a worry, especially for Tesla investors.
I won't try and extend the analogy and talk about caviar on pizza, but can you tell me about the relationship between Tesla and Twitter from here, how you expect that to develop in any way, shape or form?
The biggest problem, Ed hit on it, is does he have to sell more stock? I mean, we believe it could be up to $3 billion that he sells, and that continues to be a bit of an overhang. But I think a contained overhang here. But the broader worry is just key man risk. I mean, does he start to juggle too many balls at the same time? Twitter's a new kid on the block. Tesla needs Musk more than any other time, given what we're seeing in EV supply chain is coming off a delivery miss. So look, I think for Tesla investors, they're just worried. You know, this has been a nightmare. Look forward to being in the rearview mirror, but clearly there's some work to be done ahead.
It's not in the rearview mirror yet. Dan, can we finish there? Can we talk about risk factors to your view? You're not the only one who struggled to understand through the summer as to whether this would close or not. What's the number one risk that you think would prevent this from closing?
The number one risk would be the Twitter board ultimately not being comfortable with the financing, given some of the issue that you're talking about, and basically not pulling their lawsuit. Then this really starts to get complex if this actually starts to go into Delaware and they do not pull their lawsuits. And I think that probably is the most complicating factor, because of course Musk and Parag and the Twitter board are not going to be doing a candlelight dinner. There's no trust factor. They're snake bitten. That's going to be the issue.
I imagine there won't be a candlelit dinner with the banks anytime soon either, based on some of this. Dan, thank you, sir. Dan Ives of Wedbush there. Twitter a little bit lighter, softer, lower this morning. Got to pick up on the crude story too. The OPEC Plus panel recommending a 2 million barrel a day cut to the output limit, according to a delegate. Crude off the back of that is positive on WTI and Brent by about 1 full percentage point. Coming up, the morning calls and later, futures pulling back after a massive two-day rally. Goldman's Sharon Bell says the bear market has more downside ahead. That's coming up next.
About what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Minutes away from the opening bell. It's yesterday upside down. Stocks down, yields up. Stocks down by about 1.2% on the S&P. That's the price action. Here are the morning calls. We begin first up with Atlantic Equities downgrading Morgan Stanley to neutral, $85 price target, highlighting declines in its investment banking activity. Morgan Stanley upgrading Ford to overweight, seeing an attractive valuation and potential upside stemming from the Inflation Reduction Act. Deutsche Bank upgrading Church & Dwight to a buy, saying the stock historically performs well during times of consumer distress. That stock is positive by about 0.4%. Up next, bear market bounce on a real deal. Goldman's Sharon Bell sounded the alarm, seeing further downside ahead for both US and European stocks. Your opening bout up next.
Imagine simply climbing a cable into space. The concept is known as the space elevator. Not only could it significantly change how we leave planet Earth, but it could also completely transform humanity's relationship with space. And there are scientists who think we could have already built it.
We have the material, we have the technology, we have the lasers, we have the climbers, we have all of it. If a private entity wants to build it, or a government, they can build it. It'll change society. We have no clue how colonizing into space, how really spreading out into space will really change our society over the next 50 to 200 years. It'll be completely different.
The difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
Seconds away from the opening bell this morning. Good morning to you. On the S&P 500, futures negative, down a little more than 1%, following the biggest two-day pop on the S&P, going all the way back to spring 2020. On the Nasdaq, at more than 5% in just 2 sessions. Right now, futures negative 1.36%. There's your opening bell. Switch at the board again to the bond market. Yields much lower than they were last week, but higher than they were yesterday. Up 8 basis points on the day now to 371 on a 10-year. In the FX market, euro dollar negative 1%. Yields up, dollar stronger. Euro dollar 98.77. Looking at cable, 112.91. What a range on the pound today. The high 114.95. The low is right now. We're down 1.6%. Want to finish on crude, up 0.9% there, $87.30. OPEC Plus coming together, and it looks like they're going to deliver a 2 million barrel a day output cut. This is going to be very controversial in Washington. We're going to catch up with the team on the ground in Vienna through the day. We'll catch up with Anne-Marie over in DC in just a moment. Let's get you some price action at the opening bell. Let's get to Abby for a little bit more. Hey, Abby.
Hey, John. Well, cooling off, that's the name of the game after the best two-day rally for the S&P 500 going back to April. Today, the big winners of yesterday and Monday, they're down. Apple had gained $120 billion in market cap over the last 2 days. Today, down 1.3%. This, of course, as you were just outlining, yields are higher. That, of course, is pressuring valuation. Same deal for NVIDIA. NVIDIA had added 8.5% in 2 days. The stocks also up that amount. Interestingly, Morgan Stanley is saying that chips are likely to cool off. We're certainly seeing that today for NVIDIA. Carnival down 4.8% over the 2-day rally of Monday and Tuesday, up 10.4%. So again, investors selling what they had been buying. And speaking of buying, John, well, Twitter, it is down 3%. The deal's back on, and that means that yesterday's 20% pop, well, a little bit of consolidation there. But to Ed Ludlow's point earlier on, the fact that it's close to that 54.20 price suggests market investors think the deal will get done.
Stock is all over the place. We're down about 2 or 3 percentage points in early trading. Let's get back to Ed for a little bit more. Morning, Ed.
Yeah, good morning, John. I think the sell side at least is sanguine about this. They look at the equity market reaction we saw yesterday, the big jump in Twitter shares. We're giving some of it back at the open here, but they say despite the unknowns and despite the uncertainty, there are a few maneuvers left for Musk to actually use, and so we feel like we're moving towards the close of this transaction. What is still unknown is what Twitter does. They actually need to decide how they handle the legal proceedings, which are still active in the Chancery Court in Delaware. One of the requests that Musk made in his letter to Twitter was, we can move forward at the original terms agreed in April, $54.20 a share, if there is a stay of legal proceedings. There was no indication from the communications Twitter gave out last night that that is the case. We look forward to it. Then there's what happens next in terms of the pace of closing the transaction. Many of the conditions set out in April which we're sticking to if Musk is to be believed in terms of the original terms of that deal, have been satisfied. And what does Twitter look like in the future? Let's not go there yet. I feel we have a long way to go. Tesla also under pressure, of course, this idea that he will have to sell some Tesla stock to finance the equity financing portion of this, and the idea that he's already CEO of 2 companies. What if he becomes CEO of Twitter, which would be a third? He's a pretty busy guy.
A pretty busy guy already. Ed, thank you. It is hard to keep up with this. One thing we can all agree on, because by definition it is true, is that a lot has changed between April, when we were talking about this deal getting done, and now in the equity market and in the debt market too, both in the market and in the economy as well. Amazon, the latest tech giant to try and control costs following Meta in hitting the pause button on hiring. Taylor Riggs has more. Hey, Taylor.
Yeah, John, and similar to what we were talking about yesterday, right? Not layoffs, but a hiring freeze and a maybe reevaluation of some of the recruitment practices that they have until the end of the year. So Amazon, of course, they announcing that it would be more the corporate positions in the retail business. Nothing about some of the warehouse workers as well. But nonetheless, this is an interesting story given, of course, what you mentioned about Meta as well. When you think about the number of employees, John, I think what's really interesting is Walmart's been, of course, the big private employer. I was taking a look at a number of employees for Amazon. At the end of last year, 1.6 million, and that was also sort of a quarterly number. But then the second quarter, we've dropped to 1.5 million employees when you think about Amazon. So maybe looking again at a little bit of a smaller company next year than we have this year. That echoes some similar comments that we've heard from Meta and Facebook.
Taylor, do you think this speaks to the data we've seen, that claims are below 200K, that job openings came down 1 million, that these companies aren't talking about layoffs, they're talking about not hiring anymore? We're talking about freezing.
I hear anecdotally and in some of the data, John, that you know, that laying off is so hard because it's hard to get workers in the door, that hiring freezing, of course, is a much easier step to take. There's also some interesting data, as you know, in that ADP report about the wage gains for workers who are not changing jobs versus the doubling of that number for workers that are changing jobs. So some interesting anecdotes as well.
Speaks to the quits rate. Taylor, thank you. We've used this line a few times. It's not mine. I've borrowed it from someone else. But you can't fire what you couldn't hire. And maybe that's what we're seeing in job openings. Or they've just been filled. And we'll find out on Friday if payrolls are exploding. The moves we've seen in the last couple of days, big. A little bit of a move lower this morning. We're down about 8 or 9/10%. Some of Wall Street's biggest banks were not buying the 2-day bounce in equities. Kaylee Lyons has more. Hey, Kaylee.
Hey, John. Yeah, a big bounce it was. The best 2 days for the S&P 500 going all the way back to April 2020. But if anyone out there wanted to believe that the rally was going to continue, the bears on Wall Street are saying, hold your horses. We don't think so. The latest out is Max Kettner over at HSBC, who has cut his year-end price target for the S&P 500 to 3,500, joining the likes of Goldman Sachs, Bank of America, Morgan Stanley, all of which see more downside from here. What they're warning about is that prices still don't fully reflect the risks of higher interest rates on earnings and on valuations. And that is why we have seen a steady decline in the outlook for stocks. Back in April, the average year-end target among Wall Street strategists was around 48.46. By mid-September, that was down about 500 points to 43.46. And now with the recent downgrades we have seen, not just from HSBC, but even Jonathan Golub over at Credit Suisse earlier this week, that's likely to go even further south come the October survey. And speaking of going south, a lot of these bears, as I said, are expecting corporate earnings to go in that direction, and that the downward revisions are going to come in a much bigger way. But they have not yet. So far, no earnings recession is in the forecast. Yes, EPS growth is expected to slow to about 2.9% in the third quarter. Results we're going to get very shortly, but then it's expected to pick back up, and in the fourth quarter and into next year, maybe still a little bit too optimistic if you listen to all those shops I was just rattling off, John.
Okay, Eddie, thank you. That is a wonderful summary. We can continue that conversation. A simple question: what are the preconditions needed to add to equity exposure? Sharon Bow laying out what needs to be seen to call a bottom in equities and saying the following: we need genuinely low valuations, an end to the deterioration in growth, a peak in inflation, and rates and light positioning. We would argue we are not decisively there for any of these in the US or Europe. Sharon from Goldman Sachs, I'm pleased to say, joins us right now. Sharon Bow, wonderful. Let's start there. The preconditions to add to equity exposure. You went through a list of things there. Are we closer to achieving that in the US or Europe?
That's a good question. I think on the valuation front, Europe is decisively cheap versus its history. Not necessarily versus other asset classes like bonds, but just in absolute terms, the PE is quite cheap. So yes, on that front, maybe on positioning as well. People are quite under-positioned in European equities because of the risk, because of the war, because of the volatility recently. So on those counts, yes, but probably not on the count of an end to the deterioration in growth, which I would argue is the key one. And in the US, still not all that cheap versus history. Valuation on the S&P is about 16 times forward earnings, which is sort of long-term average, not particularly inexpensive. Positioning, yes, it's probably relatively low versus history, but not at rock bottom levels. And the deterioration in growth, well, you've just been discussing the employment figures, they are coming down. So I think that, again, on both counts, not particularly close at the moment.
Sharon, just going through your calls, underweight the consumer, overweight the banks, energy and basic resources. Can I just pick out two of those? The underweight the consumer and the overweight the banks. Can you reconcile those two things?
Yeah, I do think this cycle is going to be very different from the last 4 or 5 that we've seen. So if you think about it, particularly in Europe, and my main focus is on European stocks, banks have generally performed incredibly badly in the last 10, 15 years, ever since the financial crisis. But ever since the financial crisis, we've had low inflation, we've had low rates, we've had disinflation. Now we have some more inflation, now we have higher rates. And that's great for the net interest margins for the bank sector. Of course, they do get a hit by maybe non-performing loans. As you see economies weaken, they get hit by a lack of loan growth, as you see the housing markets perhaps turn with higher interest rates. But I think overall they'll gain from higher net interest margins, and that will be unusual for them. They haven't seen that type of improvement in the last 15 years. Also, household balance sheets are reasonably good. So yes, you're seeing a tightening in terms of a hit to the cost of living. You're seeing higher inflation, you're seeing low real income growth, but households in aggregate still have net savings, and they can use some of those to pay off higher loans. And as long as they have jobs, unless there's a very sharp deterioration in the labour market, I would expect them to continue to pay loans and mortgages. So I think banks will be less cyclical this time, is what I'm saying, and actually have got something to gain from higher interest rates.
Everything you just said, though, about the banks becoming less cyclical and perhaps even defensive off the back of rate hikes, Sharon, do you think that's good enough to attract capital, given how concerned some people might be about financial stress across the continent?
Yeah, look, I think that's an absolutely valid point. And I should say the other thing about banks is they are extremely inexpensive. They're trading on valuations which are mid-single-digit PEs. This is below the levels they were at in the sovereign crisis, for example, where people were genuinely worried about the sort of integrity and sticking together cohesion of Europe. So I don't think we're at such a risky point for banks now, and I think they shouldn't be on such low levels of valuation. That is not to say there are no risks at all for banks, and sort of financial market volatility is, there's some benefits to that for the banks, but generally speaking, that adds to the risk premium, and that's not helpful for banks' valuation, and that's why they already trade on very low multiples. But the dividend you get from banks is pretty good, 5 or 6%, and the payout ratio is not particularly high, so they're being pretty conservative.
How have they traded, Sharon, in the last few months? Have they traded tightly with peripheral spreads, or have we broken that correlation finally?
It's not completely broken. I think it's not as tight, though, as it was during the sovereign crisis or other periods where you've seen peripheral spreads widen. And I think the reason for that is a couple of reasons. One is they're not actually big holders of peripheral debt anymore. Even the Italian banks aren't that large holders of peripheral debt. And why is that? It's because who owns the peripheral debt now is largely the central bank, having done years of quantitative easing. Also, the banks have been keen to reduce their exposures to more risky assets like peripheral debt. They've improved their capital levels, they've reduced those type of risk assets. So I think overall they've been slightly less tied to sovereign spreads. But that doesn't mean, of course, they won't be a little bit tied to that, and they certainly are a domestic European risk asset. They also tend to be hit when domestic currencies come down. So the euro and sterling coming down is unhelpful for the banks. Why is that? They don't really import in a lot of goods, but they're not exporters. They don't generally make money overseas. So it's the companies and sectors that make that money overseas that do better when European currencies are falling. So on a relative basis, they've lost out from that. But generally speaking, year to date, banks have not been underperformers. We've had the market come down. We've got severe risks of recession. We've got consumer confidence at rock bottom levels for the last 40 or 50 years. And yet banks have slightly outperformed in Europe, which I think is very telling that they are acting differently this cycle.
It's a tough moment in Europe, that's for sure. We've talked about the banks. Let's finish on energy. Sharon, can you tell me, just from a structural standpoint and what you see playing out in Europe at the moment, access to energy supplies, etc., whether you think these issues go beyond just this winter, and if that's a reason to maintain an energy overweight even in a difficult part of the economy cycle?
Yeah, so again, I mean, energy is typically a cyclical sector, isn't it? But it's demand and supply driven. So absolutely, I can see demand coming down. We have a recession across Europe through 2023, and that's going to hit demand. It's going to hit demand for energy. It's going to hit demand for many different assets. But there's also a supply side of this equation too. With OPEC potentially withdrawing some supply, with supply anyway incredibly tight for lots of commodities, including energy, I think that will keep prices relatively high and makes that sector quite attractive. In addition, just like banks, it trades on an incredibly low valuation, mid-single-digit PE multiples, a dividend yield which is very well supported by earnings and cash flows, and is around about 6%. So good dividend yield, low valuation, a constraint in supply, all of those things I think adds up to good performance for the energy sector. And then on your other part of your question on 2023 and sort of the energy market for Europe, I think it remains really, really tight. We might get through this winter if it's a mild winter or moderate winter, not severely cold. But as we get into next year, storage will have been withdrawn and we need to rebuild up storage, but we won't have those gas flows from the Nord Stream pipeline. So Europe will face a bigger problem in some ways in 2023.
Sharon, wonderful. It's been too long. Sharon Bow there of Goldman Sachs on Europe and beyond. Equities right now down about 1% on the S&P, on the Nasdaq down by 1.5. We talked about energy there. Coming up, OPEC ministers recommending the biggest supply cut since 2020.
They are in full panic mode. Democrats have thought they got a reprieve when oil prices fell. The last thing in the world they want or need is anything that causes prices to start marching upward again.
The White House reaction up next.
Politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect. How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
What do Formula One cars and your local supermarket have in common? Well, strange as it sounds, they might both be using the same technology. A lot of innovation has trickled down from the world of high-tech engines, and it hasn't just found a new life in road cars. F1 cars have long been thought of as the peak of cool, and technology in them is also helping to cool down our produce aisles. Engineers from Williams are using their knowledge from 9 Constructors' Championships, working with company Aerofoil to help reduce the energy consumption of supermarkets. The device they're building is based on the design of an F1 car's rear wing. It attaches to fridges to keep more cool air in the unit. They estimate it can reduce supermarket energy consumption by 25%. One innovation from F1 is also helping hybrids reduce their carbon footprint. That's KERS, or the Kinetic Energy Recovery System. In common parlance, it's known as regenerative braking and works by storing energy of the car decelerating in a battery for later use. If that's not enough, F1 is now looking at TERS, or a thermal energy recovery system, looking to harness the heat produced from braking and the engine exhaust. That could allow cars to generate the same power using 30% less fuel. So while F1 may have a reputation as a gas guzzler, some of its innovations in the name of speed are helping in the everyday fight against climate change.
What's happening on Wall Street?
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Full panic mode. Democrats have thought they got a reprieve when oil prices fell. They're facing very difficult elections in November. That oil price drop has been a blessing. The last thing in the world they want or need is anything that causes prices to start marching upward again.
OPEC Plus closing in on a deal to cut output by 2 million barrels a day, drawing pushback from Washington as Democrats look to tame pump prices going into the midterms. Bloomberg's Gillian Lee now in London alongside Anne-Marie down in D.C. for more. Let's get to you, Julian. Just what on earth is happening in Vienna?
Well, I think what it is producers don't like the way the oil market is looking and the way that it's moving. They were very concerned by oil prices below $80 a barrel. They want something that's much closer to $100, and they're acting to get it. The one thing that I would point out is that this 2 million barrel a day headline cut is in their target. It's a cut in the target. The actual reduction in production that will probably lead to is much closer to 880, 900,000 barrels a day, because so many of them are well short of their target levels anyway.
Anne-Marie, do you think that brings any comfort to the White House?
Well, that's exactly what does bring comfort to the White House, Jonathan, the fact that this isn't 2 million barrels a day coming off the physical market, which means there could be a spike in the price, but potentially then it'll settle down, which is why I'd say the White House is not so much in panic mode, but they're probably a bit annoyed at the fact that the optics of this and the timing is not ideal at all. So when you look at the timing of this, in 5 weeks from now, Jonathan, you're going to be sitting next to me here in Washington, D.C., and we're going to be talking about the midterm elections and potentially what many would call referendum on the presidency. This does not bode well for the White House 5 weeks out from the midterm elections. Then on top of that, the optics of this are also discouraging for the administration with the fact that you have a newly sanctioned Russian official. He is the head of OPEC Plus diplomacy out of Russia, the Deputy Prime Minister, Alexander Novak, physically in Vienna. He'll be sitting side by side with Prince Abdulaziz, which arguably the Saudis are the United States' strongest ally in the Gulf. So the timing and the optics of it is what is very discouraging for this White House, not so much that potentially this might not move the market.
Julian, options. One option on the table, and it's been talked about in the press for a long time, several reports over the last several months on this, and the Energy Secretary has not exactly batted them away. Exploring maybe restricting, constraining the ability for US companies to export crude product. Julian, what do you make of that?
I think it's a terribly bad idea, not just for the US. I mean, it's a bad idea globally. I think it will create real problems in Europe, and I don't think it will solve any of the problems that the US administration is trying to solve. I mean, you know, look at crude oil prices when there was a ban on crude oil exports. West Texas Intermediate followed Brent, not in lockstep, but very, very closely. There was no real difference between crude oil prices in the US and crude oil prices elsewhere, and I think you'll see exactly the same with refined products. But what this will do is it will disrupt the flow of the market, and that has to be bad for prices and for security of supply.
The good news is that gasoline prices, on average, aren't at $5 anymore. In America, they're closer to $3.80. But over the last few weeks, Anne-Marie, they're starting to break higher, just a little bit. When you think about the options available to the administration, can they lean on the SPR a little bit more? What are the options available?
Well, Jonathan, just quickly, not only are prices on average across the U.S. are starting to break a little bit higher, but if you look at pockets of the country, Oregon, California, you have much higher prices, like $5 a gallon in some places in California, which is why you see Representative Ro Khanna really go after Saudi Arabia on Twitter recently. So what the U.S. potentially has is JP Morgan analysts say they can use the SPR. Halima Croft, in her postcard from Vienna last night, talked about the fact that Ron Klain seemingly said that they can use the SPR to offset the OPEC production cuts. But she's not expecting a big blockbuster use of the SPR, but potentially this could be one of the tools in the toolbox, as what Julian is saying, that the Department of Energy is also looking into potentially what it would mean if they were to have these export controls on gasoline and refined products.
Unreal. Operation Midterms in full flow, it seems. AMH down in DC. Julian Lee, to the both of you, thank you. Crude bouncing from a little bit early this morning off the back of these headlines. More headlines for you. Here's Abby for more. Hey, Abby.
Hey, John. Well, yes, we do have the U.S. Services PMI and Composite PMI, the final reading for the month of September. Both came in a little bit better than expected at 49.3 and 49.5. That's still below contraction. What makes this so interesting, the manufacturing, of course, came in at 52, and we have not had those ISM numbers come in below 50 at all. Still an expansion. That has to do with those are bigger companies, John.
Abby, thank you. Up next on this program, your trading diary, live from New York, with equities trying to recover. This is Bloomberg.
The satellites have propulsion systems. They can kind of move to get out of the way of each other or change their orbit a little bit. It's a service that you guys offer to help these companies know how to maneuver their machines.
Yeah, we offer a collision avoidance service. It's a subscription service. We'll send you an alert up to 7 days in advance if your satellite's going to come dangerously close to a piece of debris or another satellite.
Companies have been doing that for decades, moving satellites around, but it's sort of like a harder problem now.
The risk of a collision is a lot higher now, just because we've installed so much more hardware into space. You have a big collision, it creates a cloud of debris, and now all the other satellites are flying through this whizzing mess of debris. As we add all of the new satellites into space, the risks of the collision, the likelihood of the collision is going up.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
Welcome to Bloomberg, the lineup.
If I say bond yields are up, you can probably guess the stocks are down. We're down 0.9% on the S&P 500. Outperformance from the energy names. Energy stocks on the S&P up around 12 percentage points over the last 3 days because crude is up by more than 8% over the same time period. We'll talk about OPEC Plus through the day on TV and radio. That's the price action. Here's your trading diary. Coming up at the top of the hour, ISM Services, plus Mike McKee speaking with the Fed's Mary Daly. Looking forward to that. President Biden speaking at 3:15 Eastern Time. Then you'll get some more Fed speak, Kashkari and Bostic. Later again this afternoon. Evans and Mester on deck for Thursday. Another round of initial jobless claims. And then finally, the payrolls report to close out Friday and get you to the weekend. From New York City, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari-sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we had mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought